Well, I think it's going to be very difficult to replicate. Of course, in 2020 we had a really compressed technological shift in the way we work, the way we live, and the way we communicate with the outside world and so on. And so we think that these numbers will be difficult to replicate going forward.
The GameStop saga shows how small retail investors can suddenly turn the table on some pretty big positions. What does it mean for asset managers across the world? What does it mean for the Norwegian Sovereign Wealth Fund?
Well, for us, it doesn't mean very much because we are a very, very long-term investor. We're also a large investor, and we have no exposure to the company you mentioned. So for us, this has no big implications.
Mr. Tangen, Tom Keene in New York, thank you so much for joining us today. It seems almost visionary with all the controversy of your selection that as a hedge fund guy with all of your charitable events and, of course, the wonderful British Museum show you sponsored recently. What I find fascinating, sir, is I've let the fox in the chicken shed. You have such an advantage at a sovereign wealth fund with your hedge fund experience. How are you counseling your wealth fund to buttress against the excesses of hedge funds in 2021?
Well, first of all, I have to say that the mandate we have from the Minister of Finance is to operate very close to the index.
Of course.
So there are limits to the kind of freedom that we have. And so I think what I bring to the party is more a focus on process, is how we structure that, how we focus on process rather than short-term results and so on. And so I think that's where I'm hopefully will add some value.
No question you can add it on process. Tell me how that develops the word no in the selection of a weighting of obvious stock selections. How do you pull back from too much diversification or too little diversification?
Well, the diversification is also actually decided by the Ministry of Finance. We have a reference index which we relate to. And then, of course, we have a kind of a risk budget that we can use to be underweight or overweight particular stocks. I think perhaps one of the more interesting things is in the future to be underweight some of the more risky situations, and that's where I think we can add quite a bit of value.
Mr. Tangen, do you think that the markets are currently relying too much on economic stimulus, and does that give you, concern going forward?
Well, it's very clear that we have a record stimulative, monetary policy. On top of that, we have record fiscal policy, which is kind of on top of that. And so it's very clear that that is what has been driving the market over the last period. Whether that will continue or not, it's difficult to say.
I know that there's a huge spat between the European Union and AstraZeneca in terms of vaccines, the accessibility of these, and the rollout. Do you see various countries basically going different speeds depending on how fast they can vaccinate people?
Well, the speed of vaccination is of course an important factor when it comes to how countries and economies come back. But just that particular discussion, I think I don't think I should comment on that one.
I'd like you to comment on what you just said, a very important statement, Mr. Tangen, the idea of the underweighting of risk. How do you affect that strategy at something as massive as your wealth fund?
We can't do it 100%, but we can take down risks in areas in particular where we think, for instance, there is an accounting situation, right? So we did not have we had a very, very small position in Wirecard, which was an accounting fraud because of the work we had done on the forensics side. And I think that's where we can add value. We also actually do ESG risk-based exits. And we have done a range of those over the last few years, and now we sell down companies which don't live up to our expectations on climate and so on, and that's also something we're going to dial up.
It sounds like a security analyst from Casino from years and years ago. This is really important, Mr. Tangen. I want you to dovetail ESG and the study of ESG into creating true alpha. How does that process work?
Well, it works in various different ways. We have a huge amount of data that we use to screen our companies, and we screen them for factors which we have included in our expectation documents, which you can see on our website, for instance. So that's one way of doing it. But we're also increasingly integrating the ESG into the company-specific research we do, and that's important, and it gives results.
How exactly will you ratchet up, Mr. Tengen, focus on ESG to match maybe some of the big asset managers in the world?
Well, we think we are very far. We've come very, very far in this area. And for instance, from this year, beginning of January, we now announce our voting intentions 5 days before the AGMs. Now, we vote on 12,000 AGMs. And we think we will be the leading firm in the world in terms of being transparent and announcing these voting intentions ahead of time.
What's your relationship going to be with the external managers? I know you've said in the past that I think some of how you invest would be through, I don't know if it's secondary, but external managers. Given some of the uneasiness in the markets and some of what we've seen also with certain Pacific stocks, does it make you revisit that strategy?
No, actually, one of the big successes we've had in the oil fund is the way we use external managers, and we use them in particular to run our emerging market exposures. So close to 5% of the fund is now invested with these partners, and they have delivered tremendous outperformance over the years. They also make sure that we have less reputational risk. And so that's something that we added to that exposure at the end of last year. And so coming into this year, we had close to 5% of the fund invested with these partners.
Mr. Tengen, Finland is a little bit close to Norway. And yesterday, the couch crew went after Nokia and the short squeeze on Nokia. I know you don't play in this area, and I know you really don't want to comment on it. But you're a heavyweight pro in the zero-sum game of long short. Your comment on this moment that we're in?
I think the comment here would be that we are in a situation now where we have pockets of speculation, and to me that's symptomatic for a world where stocks are pretty high. People are taking risks, and as I said in the beginning, we don't think the stock market development can continue forever, and I think the kind of speculative behavior that we're seeing in various parts of the world is an indication of that.
This has been wonderful. Mr. Tengen, Francine and I look forward to the pandemic being over. We look forward to seeing you the second week of August in Oslo. That would be a good time of year. Nikolai Tengen
Sounds like a plan.
The Norway Sovereign Wealth Fund, and we greatly appreciate his attendance today. Really wonderful to speak to him, folks, and really advantaged to speak to him given all that's going on in the markets. Look for that bug that we've got up on GameStop to keep you abreast of where we are in the zaniness of the day. Coming up, after Chairman Powell yesterday, the former governor of the Federal Reserve System, Frederick Mishkin, and this is an important conversation, the gentleman of Columbia who links monetary and fiscal dynamics to the policy perspective, Rick Mishkin on President Biden. This is Bloomberg. Good morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen
And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We welcome all of you worldwide. Bloomberg surveillance, the early mornings of America as we wake up again to the long-short battle. It has been extraordinary to see. Let me get over a couple Bloomberg screens to GameStop at $450, make it $448 a share, coming off the high of over $500 a share, $513. The test is still on between substantial short interest betting the price will go down versus those saying, okay, we'll squeeze you out. Up goes the price until the shorts scream. That's been the script so far. We'll see how it unfolds this morning. Joining us now in the long short of Washington, Jack Fitzpatrick. Wonderful to speak with him yesterday on the dynamics of the moment. Jack Fitzpatrick, what's on the agenda on a Thursday?
They are moving very quickly on a Thursday and really into next week, trying to set the stage for this $1.9 trillion proposal by the Biden administration, or at least any portion of that they can get. House members have been warned that next week's work might even run into the weekend. It does look like they're going to have to essentially take two votes on this, take a vote on the budget to set the stage and then the legislation itself in order to get it through the Senate with just a majority. And in order to do that by March, which is when they want to act in order to preserve unemployment insurance, it's really going to be a race against time. So they've got to act as quickly as possible, and we may see that budget portion of the stimulus fairly soon.
Mr. Trump started his day off at 9 or 10. The Biden administration, Jack, slipping. Headlines usually out at 5 a.m. came out at 5:30 today. I don't know what that's about. Jack, is the honeymoon over?
It is about to be over, probably. There's still a push by the Biden administration to get as much Republican support as possible. We could see support come together in a bipartisan way on some of the things he wants to do early, like vaccine distribution. It would not be surprising to see them do a bipartisan portion of this. But on the big proposals that he's done, he's not getting a bunch of Republican support. So fairly soon, Democrats appear to be preparing to say, well, here's what we can do just on our own in a more partisan way.
And Jack, how much can they actually do on their own?
Probably a significant amount. When you get into this budget process, it's a very opaque process. So the truth is the Democrats don't know for sure what would get cut out by the Senate parliamentarian. The minimum wage proposal for $15 minimum wage is something that's very likely to be cut out, that they couldn't do without Republican support. There are other OSHA, work safety standards, that kind of thing. But truth be told, they don't know what that $1.9 trillion would get cut down to if they can't get significant Republican support. They could do something substantial, but they know they're going to lose some things, particularly the minimum wage is a tough one.
Jack, we've seen quite a lot of executive orders from the Biden administration, from the president. How much of the president's time is actually just trying to sort out the vaccines and the COVID relief?
Quite a bit. You do see him delegating a lot of work in terms of negotiating with Congress, despite the president's background in the Senate. The talks with Republicans in Congress and the bipartisan groups in Congress is going more to people like Brian Deese, the economic advisor, because naturally at this stage of, probably the first 100 days, the president is going to be looking at a lot of things that Trump did that he wants to reverse, that he can reverse on his own, and also, as you said, just managing the vaccine distribution on almost a technical level. So he's maybe not going to be making that many calls himself to the Hill, despite the focus that he's had on trying to work with the Senate.
Jack, thank you so much. Jack Fitzpatrick there, a Bloomberg government reporter. Now, up next, we'll have plenty more, of course, on the COVID-19. We'll look not only at U.S. centers and distribution, but also this enormous spat between the European Commission and AstraZeneca. We'll be talking to Jason Farley, Johns Hopkins nursing professor. That's coming up shortly, and this is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance. I'm Rishka Gupta with the Bloomberg Business Flash. Shares of Apple are lower. Executives came out with a cautious outlook, and that overshadowed quarterly revenue that topped $100 billion for the first time. Apple said that sales growth from AirPods and other wearables will decelerate in the current quarter. They also forecast slower services growth. And Tesla disappointed investors with mixed results. The electric car maker reported record revenue, but lower than expected profit. Still, that may be more in tune with the S&P 500 heavyweight that Tesla has become. The company's margins shrank in the fourth quarter, but Tesla's CFO expects a rebound. Facebook is warning of significant uncertainty in 2021, and it says it may not be able to grow as quickly in the second half. That came after the social network reported that fourth quarter sales jumped 33%. Online shopping during the pandemic fueled demand for Facebook's digital ads. And that is your Bloomberg Business Flash. Tom, Francine.
Ritika, thanks so much. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us now is Jason Farley. He's Johns Hopkins nursing professor. Jason, good morning to you. I want to, in a second, go to the actual vaccination process in some of the centers in the U.S., but we also have this huge spat in Europe between AstraZeneca and the Commission. Is this the ugly side of vaccine access? Is it, vaccine nationalism at its worst?
Yeah, certainly we have seen, countries, the haves versus the have-nots in this circumstance, where many countries and governments have pre-ordered massively large schedules of vaccine, and companies have now struggled both in the UK and the US and around the world to deliver on those promises. I think that what we need to recognize is that everyone needs the vaccine, and governments are under extreme amounts of pressure to deliver on promises. It looks like we are having, questions in the United States about the Defense Production Act, for example, and some debates in and of ourselves as to whether or not that can actually ramp up manufacturing. It does not appear that it would be the case. So everyone is going, how can we get more shots in arms as quickly as possible?
Jason, where are we in the U.S.? If you look at state by state, are we going to see a much more cohesive approach coming from the federal government?
Well, I certainly think there have been great promises about the federalization of the response, certainly increased amounts of vaccine going to states, the potential use of National Guard at the state level. FEMA, the Federal Emergency Management Association, is certainly been activated. I think each of these steps along the process of the chain of supply and of distribution and administration are going to be essential and to ramp up and accelerate vaccine. But states can only go as fast as the supply that they receive.
What's the state of the U.S. right now? Do people want to get vaccinated? What's your next? Do you have enough doses to vaccinate?
Certainly do not have enough doses to vaccinate the entire U.S. population. In terms of who wants to get vaccinated, we're already seeing disparities emerge. We will see, our hardest hit communities are people of color, so Black and brown people, but yet we're seeing that the majority of vaccines are going to Caucasians or white people. So we're really seeing this disparity that has emerged, and that's driven in multitudes by both the access points to the vaccine, as well as the cadre of people who've been determined to receive the vaccine. And then the third point here is that we've got a considerable amount of vaccine hesitancy, meaning that people actually are afraid of how quickly the vaccine was developed and want to basically wait and see how others respond to the vaccine before they themselves stand in line.
What is the one thing that, we should change, if anything? So in the UK, it's been a politics of the government that you need the first dose, and then actually we can delay giving the second dose. Should the US go the same way?
Well, certainly we have a window of opportunity between dose 1 and dose 2. It's not you go beyond for Pfizer 25 days and suddenly the vaccine is no longer efficacious. The problem with extending between dose 1 and dose 2 is that we've seen absolutely infections in the studies between dose 1 and dose 2. So when you add in the circulating strains in the UK that are very concerning with the various variants, looking at South Africa and Brazil, the longer we wait between doses, the more that we have the potential for someone getting exposed to a variant that then puts pressure on that variant to further evolve. So really, it's about how expediently we can get dose 1 and dose 2 as quickly and appropriately timed as possible.
And Jason, if the developing world doesn't get vaccinated at the same time, does it multiply the danger of new variants?
Well, certainly what we're seeing with the data, particularly coming out of the UK this week, is that not only is greater transmissibility in greater numbers of transmissions equal to greater hospitalizations, of course, but that also allows more circulating virus to potentially grow and evolve. And so what we really need to do is figure out a way to, at a global level, stop the spread of this virus. Otherwise, as new variants pop up, it certainly places the current vaccines at risk of the potential loss of their efficacy.
Thank you so much, Jason Farley there. of Johns Hopkins, and be sure to check out VR US Go on the Bloomberg terminal for the latest information. You can also tune in every day for our exclusive conversations with Johns Hopkins experts for an inside look at battling COVID-19. A lot of the focus not only on volatility, but global stocks actually falling further from records. There's a lot of concerns about earnings, a lot of questions about valuations, coronavirus trends, and of course, we talk about the fallout from GameStop. More Bloomberg surveillance next. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Clearly a bit of froth.
Markets are kind of treading this very fine path between stimulus optimism and virus pessimism.
As long as equity prices are high enough, everybody's happy. But we can't do this forever.
The institutional players know what they're doing here. It's the retail investors that could end up getting hurt.
We have a massive wealth rebalancing going on right now in the world.
Not every company can be an Apple or a Tesla. And I think now people are looking for stuff that probably doesn't really exist.
Next year, when things start to look more normal, then you're going to have the hammer come down on some of those companies.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from Las Vegas. No, I do it again. From New York City for our audience worldwide. Good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. It has felt like Vegas on Wall Street for the last couple of months. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures down 8 on the S&P 500. Tom Keene, take it straight. to the roulette wheel, please.
Let us digress here, folks, and say thank you to our team yesterday amid the chaos, and we're going to drive forward again, adult entertainment. We will describe the shorts, we will describe the longs, we will describe these important issues. But also, and I know I don't want to step on Lisa here, John, but did you know we may actually look at the unemployment of the United States of America, as Mr. Powell mentioned yesterday?
Before you get too serious, you are redefining adult entertainment this morning, Tom. That's for sure.
But you mentioned Las Vegas, so I thought I'd go there. John, GameStop threw 500 about an hour ago.
I can see. It's unreal. But Lisa, the real business, 8:30 Eastern.
Well, it actually goes together, and I will tie the stories together this way, because there is a real populist anger underpinning the whole GameStop saga. If you take a look at the chat rooms, stick it to the man is the theme, whether that's driven by manipulators out there who are just trying to push their view. We will discuss that, but really underpinning this all is an economy that is struggling. 8:30 a.m., U.S. initial jobless claims. We're expecting another print of near 1 million people filing for unemployment, the expectation being 875,000. Coming down a little bit, the expectation is from last week, but not that much, highlighting the need for more assistance. 1:30 p.m., President Biden is signing an executive action or 2 or 3 or 10 targeting access to health care. Question that really we need to address is his use of executive orders. He has been signing as many executive orders as he can. The New York Times coming out with an op-ed saying, slow it down, pump the brakes, and try to get some sort of congressional consensus. That definitely becoming a growing concern. 5:10 p.m., the Reddit co-founder, Alexis Ohanian, to speak on Bloomberg Television. This goes back to the GameStop story, the idea of these chat boards and what kind of role they play in fostering some of these huge run-ups in the stocks. What kind of regulatory action, what kind of oversight is necessary at a time when people view this as populists, as the common person just voicing their opinion and their view? John.
I love Chairman Powell's reaction to this.
Oh, dear Lord.
Yesterday in the news conference. Before we get to the rate story, Tom Keenan was asked about this several times. I just felt him screaming, are you serious? We've got 9 million people unemployed.
Yeah.
We're this far away from getting back to full employment, and you want to talk about GameStop?
I'm so glad you brought this up, John. Two things. First, he did a Fauci yesterday where you could tell he was genuinely more relaxed than he was with the previous president. There's no question about that. But also, John, as you mentioned, and there was a point about 2/3 of the way through where he lost it. You know, as much as Chairman Powell can lose it, he made really clear, come on, there's 9-10 million people, we're short on jobs, nothing else matters. I do suggest Gina Smilik's first question was appropriate, and he stepped aside nicely.
I would agree with you. Futures this morning, we're down 7 on the S&P 500, off by 0.2%. Let's get to things cross-asset. Your yield on a 10-year briefly south of 1% this morning, unchanged at 1.0077%. In foreign exchange, euro dollar 121, coming in about 0.1%, but you don't care about that, do you?
Nope.
They only care about one thing this morning once again, Tom.
Yeah, there's no question about it. I mean, John, here we are. Why don't you bring in Romain here, who's hand rested and ready to go? I mean, come on, John. This is serious stuff, and Romain's really dove into it.
Pre-market prices remain only one place to go to start, and it's not equity futures right now.
GameStop, of course, John. It's all about GameStop. We closed at 347 yesterday. That's up 140%. There was sort of a brief sort of chill that went through the market. GameStop actually dropped all the way down to 311, if you can believe it, in the post-market, though. This morning, it got above 500. Right now, sitting up about 32%. Around $450, 460, if you will. We should point out too that you wake up in the morning now. I mean, in the old days, John used to check Dow futures to see what was going on. Now you wake up, you look at the Reddit boards. This is what they're talking about: GameStop, Sundial Growers. That's basically a penny stock of a cannabis company that nobody really paid attention to until a few days ago. Up 61% here, and AMC up a paltry 6%.
Wow.
But it was up 300% yesterday.
Well,
Forget
yeah,
GameStop.
it's so slow, but Romain, you're in the afternoons, and it's very important for folks to understand there's long, short, and the behavior of a short squeeze is different, Romain, in the morning and during the trading day. What did you and Joe Weisenthal observe yesterday? What was the behavior of the long crew, the guys on the couches? I've been defending them all morning.
Right.
What was their behavior yesterday afternoon?
If you want sort of a good microcosm of what's going on, look at the price action, maybe the last hour or so of trading. What you started to see? You started to see significant sell-off in some of these names. But as soon as you would drop a couple of bucks, you would see a flurry of activity, of buying activity, come in to push this back up. Now, Who is that buying? Now, the general theory is that has to be some of the shorts probably trying to cover. But this is the thing now. At some point, the marginal return between that drop down and then that pop back up is going to get smaller and smaller. And eventually, this will run its course. At least that would be the theory that you would generally subscribe to here.
Romain, there's also a question about the call options and the role of derivatives in driving a lot of this. Sarah Ponzak pointing out that nearly 38 million call options traded yesterday, the most ever. Can we get a sense of what proportion this is the retail investor really, and how much this really is professional, sophisticated investors taking advantage of this sort of mass wave, this mass hysteria and call to invest in specific stocks?
Well, the easiest way is to look at sort of what the size of these orders are with regards to the number of contracts being bought. And generally, we are seeing them kind of in the 10 or below, which seems to suggest this is mostly retail traders. I could tell you right now, we talked about this on the show last night, if you're really trying to make sense of the price action and draw a direct line either back to a hedge fund or back to an individual trader, you're going to have a hard time doing this. Everything is really skewed right now. And we actually had a couple of short sellers on our program yesterday, including Gabrielle Greco, who talked about this, is that right now a lot of short sellers, they're still active in this market, but they're really going, they're bending over backwards to really obscure what they're doing right now. Absolutely.
S3 published Romain on Zero Hedge last night and throughout their media. S3 said simply, short interest on GameStop this morning is 130-something%. The shorts have reloaded the cannon, correct?
They've reloaded the cannon. In fact, I made my own index, Tom, my own custom index, where I went through all of the most shorted companies. So basically, you just do the ratio yourself on the Bloomberg terminal, overlay that with the number of open interest that you're seeing with regards to puts and calls, and you get the list of names. Some of them are the names we've been talking about a lot the last few days, like the Expresses and AMCs, but there are a lot of other names that are popping up here, and you're seeing the activity, such as Opco, Viacom, Iron Mountain, 3D Systems, Build-A-Bear, a lot of names now that have nothing to do. Well, it could be. Some of these could end up being Dow components at the rate they're going. But look, at the end of the day is you start with a GameStop where you actually did have a fundamental story here, a company with $5 billion in revenue, a company with $3 billion in assets on their balance sheet, and then you compare that to a Sundial today that had less than $100 million in revenue and negative free cash flow.
Stop.
Yeah.
The number one thing here is the float interest, the short interest rather, is out way over 100%.
On several of these things.
How does that happen? Tell our audience right now how you go from a 20% or 30% responsible short interest, part of capitalism, out to a more than all the stock short interest. Is that anything different than John Farrell's Las Vegas?
It's called leverage and euphoria, so no, it's not much different than John Farrell's Las Vegas.
John, leverage and euphoria.
Romain, thank you.
That was an Ashford and Simpson song about 25 years ago.
Is that another band from the 1950s?
On 72nd Street. But
hey, Romain, appreciate the catch up.
Brilliant.
Thank you, sir. Thank you very much. There are some other things to talk about.
Nah.
Might be an audience here, but Apple had some earnings after the close yesterday. Don't know if anyone wants to talk about Apple.
Not really.
Maybe. $100 billion plus in sales. What we talk about a $20, $30 billion game company. Can I just say something about video games? I think once you're over the age of 30, it's done. And I don't understand the Peter Pan nonsense. Why are people still buying video games at 30 plus, Tom? I can't get my head around that.
Are you looking at me?
At all. Have you got a games console?
I got them all. I like
really?
PlayStation best. The new PlayStation is really pretty good.
Don't get it.
This PSA was brought to you by Jonathan Farrell. Although Build-A-Bear, you're very much a pro if you're 30 plus doing lots of building.
I think I've been to a Build-A-Bear.
All right.
Never been to a GameStop.
Let's go to Anahan.
Anahan will appreciate this conversation.
Will
she joins
she?
us now from Wells Fargo, equity strategist. Anna, it's got ridiculous. Can you just give me an idea, just a snapshot? You don't have to name names. Just walk through what a phone conversation, a Zoom call like with a client in the last 24 hours.
Well, clients certainly want to know where and the power of this retail flow and how much do they need to keep that in mind when they look at a picture, not just day to day, but think more 6, 12 months down the road. This retail flow, I think the power we're seeing now, it's not out of nowhere. It's just before it was diversified. It was in passive funds. It was spread out across a lot of names. But when you see that concentrated in single names, you got to put some respect on that retail flow. This is no longer smart money versus dumb money, it's a force to be reckoned with. But we think longer term, the bigger driver still going to be the economic recovery.
So that's why a lot of Wall Street is saying buy the dip. However, there is a question of how long the tail can wag the dog, as John Farrow has been pointing out, with all of this options activity and the hedge fund unwinds that we've been hearing about. How much further does a broader sell-off have to go before we hit some sort of bottom here?
Well, the broader sell-off, it's not in all parts of the market. You are seeing more weakness in places where, you've seen high growth, high momentum. And part of that could be investors taking some off the top, taking some profits, which we think would be prudent, especially if you've had such a great run on them. Why not take some from there, use it as a source of funds, and rotate into something that you think would be a little bit of a hotter growth trade, or excuse me, higher earnings growth over the next 6 months. So that equity weakness, it's also because of that expectations have been so high. And as you saw with earnings season, you were mentioning some big names earlier that reported last night. Great numbers, but still, when expectations and the bar is so high, you can't help but investors feel a little disappointed.
Anahan, we had Ann Richards on from Fidelity International an hour and a half ago. She's brilliant electrical engineering out of Edinburgh. Let's do the physics right now with Anahan. Anna, when you look at the physics of this moment, I understand these trades will close out. They close out with leverage losses. There's no question about that. Is that going to be discrete and closed within that market, the hedge funds and the guys on the couch, or is it going to redound over into your world?
I think you're going to see some ripple effects, Tom. Nothing really happens in isolation anymore. And if there's any evidence of that, it's that connectivity we see amongst the trading market, amongst whether it's at home, in your pajamas and fuzzy slippers trader, or it's those institutions. You're going to see repercussions of it. But how deep those go and how long, who it hurts most, that remains to be seen. But, that leverage and the technical aspects of what's going on are really need to be respected, and they're no small thing.
Anna, are you willing to draw a line between what happened in the single name mania yesterday and the downdraft we saw in equities?
Well, when you say draw a line, I won't say that they're completely separated. You are seeing activity in these constituents, and it does get people to speculate and draw conclusions about, comparables for companies within the S&P 500, what it means for certain sectors and industries that are related to what's going on, the more idiosyncratic stories. At the same time, again, we don't think they're the main driver over the longer or mid-term. So keeping that in mind, we are watching that day to day. But, longer term, we still like those cyclical groups. We still think that the high growth groups are a little elevated in valuation and will be hard to continue impressing investors. And we think that, the defensives and that volatility picture continues to decay. But, we're hitting some speed bumps. It's not surprising.
Anna, great to catch up. Anahan there, Wells Fargo Securities equity strategist from New York this morning. Equity futures recovering just a little bit as Apple recovers in the pre-market as well. But there's only been one story. And I think Anna really nails it, Tom, when she said that you need to take this retail flow story seriously. Yeah. We can have a laugh about it, we can joke, but it's serious. Yeah. It's having implications for what we're seeing in markets.
John, Greg Vallier moments ago, a blistering note published that Gary Gensler will be involved in this. I love Vallier's phrase where the hunter has become the hunted. And of course, hedge funds going after these troubled stocks. And now they figured out the game where the hunter is truly the hunted here as we see GameStop move up as well. I believe that's 88 right now as well. My eyes are failing me this morning, John. It's just,
just this morning.
Just this morning. It's a one-off. It's a Thursday.
I'll let the lawyers deal with the legal stuff.
Yeah.
I think the short side is very important for price discovery. Pretty much everyone will agree with that.
Totally.
What's interesting to me, though, and we've talked about this repeatedly through the week, Tom, are the people that use the short story almost as a marketing tool as well.
Well, you know how I agree on this.
Yeah, and now we've got retail basically coming in and playing a similar game.
John, you've been in the meetings where I'm screaming mental about that. We have never let that on our shows. Farrow hasn't done it. I haven't done it. We don't tout it. And I have I mentioned this the other day. The way Steve Eisman does it is great. Total class, totally silent.
I think the guest bookers might want a word with you and I after this program.
Probably Iceman will be in the 9 o'clock today, for all I know.
Coming up, I hear you've got a nice little chit-chat conversation with the IMF Managing Director.
Valuable.
Looking forward to that. Kristalina Georgieva will be joining Bloomberg Year Ahead Conference with Tom Keene. That interview's coming up a little bit later. From New York City this morning, good morning. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The Federal Reserve is nowhere close to ending its massive support for the U.S. economy. That was made clear by Fed Chair Jerome Powell. Fed policymakers left their benchmark rate unchanged near zero, and Powell told reporters it would take some time for the Fed to reach the threshold for dialing back its bond buying program. In the span of 2 weeks, states in the U.S. West have seen the number of coronavirus cases go down by an average of 43%. That outstrips the decline in other regions. Improvements led California Governor Gavin Newsom to ease social distancing measures earlier this week, but that could lay the groundwork for infections to spike again. The European Union and AstraZeneca are locked in a dispute over coronavirus vaccines. The drug maker refuses demands that it take vaccine supplies from its British factories to increase doses going to the EU. Now, the root of the issue is AstraZeneca's decision to give the UK priority over the EU following a production glitch in Belgium. China's President Xi Jinping is signaling that Beijing will tighten control over Hong Kong. Xi says the semi-autonomous financial center must be governed by what he called patriots. Xi told Hong Kong Chief Executive Carrie Lam that having loyal leaders was the only way to ensure Hong Kong's stability. Lam's term expires next year. And shares of Apple are lower pre-market. Executives came out with a cautious outlook, and that overshadowed quarterly revenue that topped $100 billion for the first time. Apple said that sales growth from AirPods and wearables will decelerate in the current quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so.
Chairman Powell of the Federal Reserve, he is not concerned about your online reading club. He does not want to censor it. That online reading club line's great, isn't it? It's not mine. It's not mine. Comes from someone much better than me on Twitter. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Futures just turning positive on the S&P 500. We've got to talk about Chairman Powell a little bit later. Steen Jacobson of Saxo joining us. I'm looking forward to that, to get his view on rates and the correlation between rates and asset prices, and the correlation that the Chairman of the Federal Reserve doesn't think that tight. And granted, I understand it, that the biggest bubble we've seen in the last 20 years was actually in a rising interest rate environment. 2007, we had rates going up, and that bubble kept getting bigger and bigger and bigger in the housing market, Tom. So there is that caveat out there, but I'm not sure how many people agreed with the chairman on asset prices yesterday and interest rates.
Yeah, I agree with that. And again, at 8:30 today, we'll get what he was focused on, which is claims. I do want to thank the chairman for the paid promotion for the Bloomberg terminal at the end of the press conference, where he talked about data transfer today and how that controls so much. We thank him for that comment. Right now, we thank Emily Wilkins for joining us with Bloomberg Government. As we look at Biden, well, not 5 a.m. today. We got headlines out at 5:30. Emily, they're slipping. Is the honeymoon over?
I mean, Biden's going full speed ahead here on the executive orders. We are expecting more today, particularly focused on healthcare. That includes reopening the employment, or rather the healthcare insurance market, allowing Americans to go ahead and sign up outside of the normal window of time. And Biden, some of these executive orders will also deal with abortion and providing government funding to nonprofit agencies that provide services, including abortion counseling.
There's a theme of day. What percentages, and I don't mean to pin you down on this, but what percentage of these so-called orders are reversals of President Trump's, or are they newly created orders?
These are a high percentage of orders that are reversing policies from President Trump. I mean, we saw President Trump, obviously the Republican Party, very anti-abortion. We saw President Trump sort of go along with that, with a number of these policies. And the whole opening up the healthcare market, I mean, this is something that Democrats have been called on the Trump administration to do during the pandemic, but because of Republican opposition to the Affordable Care Act, that didn't happen.
Although, Emily, does it highlight these executive orders in the way that Joe Biden is trying to unilaterally go at reversing some of Trump's orders and going at his own? Does it highlight the ongoing divide in Washington, that the kumbaya tone that people were talking about, that there would be some sort of bipartisanship in Washington, is not real, and that really we're back to square one and the old Washington?
I mean, if you want to look at indicators that the kumbaya tone is over, I can point to at least a dozen. The executive orders are definitely there. I mean, look, there are people who are criticizing Biden for signing the number of executive orders that he has in his first couple days. There are people who are praising Biden for taking such quick action. I think part of what you're seeing is a recognition that Democrats only know for sure that they have control of the Congress and the White House for the next 2 years, and this need to sort of move as quickly as they can on their priorities, because in 2022, there's a chance that Democrats might wind up losing either the Senate or the House.
Very good. We need to interrupt here, John, and translate for you because we are jargon-free. John, Kumbaya is a song you sing at campfires, around the campfire. Kumbaya.
Wait, really?
What's the next line?
Kumbaya.
Just
the
keep
next
going.
line is Kumbaya.
Just keep going.
Oh, dear Lord. This is adult entertainment. This is adult entertainment.
Someone's watching the tots, my Lord. Kumbaya.
Right, John,
that's how it
what's
works.
the next line?
Oh,
No, that's
God,
it. I
bring
can't go
back.
further.
John,
I'm in tears usually at the campfire.
I'm enjoying this. This is too good.
Please get back
This
to
is
Emily
too
and
good.
say,
I think there's a
Kumbaya,
good
John.
chance that before the end of the hour, we take this show down from 3 anchors to 2.
Or we go to 1.
If you keep this up,
We're
if
just
you
going
keep this
blank.
up. You know who confused me yesterday? Senator Warren. You see her tweets on GameStop? Still not convinced that they're her tweets. Let me read a couple of them. With stocks soaring while millions are out of work and struggling to pay bills, it's not news that the stock market doesn't reflect our actual economy. We're all with you. For years, the same hedge funds, private equity firms, and wealthy investors dismayed by the GameStop trades have treated the stock market like their own personal casino while everyone pays the price. It's long past the time for the SEC and the other financial regulators to wake up and do their jobs, and with a new administration and Democrats running Congress, I intend to make sure they do. And she Senator Warren quote tweeted a GameStop article, Tom. And I'm trying to understand, is she against retail here or for retail?
You're dead on about the confusion, but Emily Wilkins, what is the confusion in Washington right now between the liberals represented by the good senator from the Commonwealth and President Biden? What's the separation?
I mean, in regards to the GameStop thing and in regards to wider policy.
Everything in general, wider policy. How are the liberals doing?
I mean, there's definitely going to be tension that we are going to see going forward between the moderates in the Democratic Party and the liberals in the Democratic Party. I mean, I know that some news is broken this morning from Politico about doing a potential 2-track spending bill for that big stimulus. And part of that is to appease the moderates' demand for bipartisanship, while also telling liberals, hey, we know that we control all the branches of government, well, besides the Supreme Court, and we are going to be using that power to make sure that we are really making sure to get people the aid they need during the stimulus.
Emily, great to catch up. Emily Wilkins down in Washington, D.C. Thank you. Headline coming from Dr. Fauci. He thinks double masking makes sense, according to the NPR. Tom, 12 months ago, 10, 11 months ago, where were we on masking and where are we now? And I think that the confusion over the messaging that came from the medical, the healthcare community on the one side, and then, of course, the really botched communication that came from the administration on masking as well. Double masking, and this isn't the first time I've heard it in the UK as well, because of the new variant that we're starting to see, the mutation of this virus that have become much more contagious, Tom.
I don't have any wisdom on this, John, other than to say I look at the difference between San Francisco and Los Angeles, and it tells me it's cultural. And that's like, most of this is cultural, and if that's the case, you need responsible messaging.
Yeah, I have to be clear on something else too, Tom. My experience, because I've lived this in both London and New York now, is
and
that
Capri,
and a bit of Capri and somewhere else along the side as well.
Yeah, fine.
In my experience, in the United States, it became somewhat politicized, and I think we're all aware of that. In the UK, Tom, it wasn't politicized. There was just this very sort of cavalier attitude. It was almost sort of an anti-government push that you don't get to tell us what we're doing. And it wasn't about either side of the political aisle. It's just a general attitude around masking. And I think what you will see still in the UK, until recently, is a lot of people still walking around in public without a mask, and I don't see much of that at all in New York City.
John, we got short time here, but it's so important. You led the discussion on this. Madrid is going to stop vaccinating. Does that surprise you?
Where's the vaccine going to come from? Tom, it's a huge issue. I caught up with the European Commission yesterday, and I put the question to them, is this European bureaucracy...
You talked to Lagarde yesterday?
I talked to Vestager of the European Commission and put the question to her, to the Commissioner, is this European bureaucracy slowing things down? And I got pushback. I got a lot of pushback over that. But look, the facts are clear. the contract was secured with AstraZeneca 3 months after the United States and the UK. The fact is also clear that this drug, this vaccine, still has not been approved in Europe. There may be very good reasons for that. I don't want to prejudge that, but the fact is it's taken slower to get things done in Europe than it has elsewhere. And the Europeans still aren't really acknowledging that.
Well, we'll see. Catalonia is scheduled to be out of order after Madrid here in a very difficult Spain. John?
It's tragic. Truly. From New York City this morning, good morning. Alongside Tom Keane and Lisa Abramovich, I'm Jonathan Ferro. Coming up, Steen Jacobsen of Saxo Bank, the CIO, on rates, this market, and some of the crazy price action over the last couple of days. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg TV and radio. I know at the best of times, no one really cares what I've got to say, but I can tell you for the next 2 minutes, no one really cares what I've got to say. I'm just going to go through the main markets. I know, really, I'm going to avoid the single name mania. I'm just going to stick to
things like the S&P and the NASDAQ. I know. S&P 500 futures doing nothing. We erased the loss of this morning. Apple helping things out there. Tom, we've gone back and forth about the capital return program at Apple. Light Shed and the team over there, Walter Piecyk, we've cut the share count at Apple by 35% since 2013.
And it's different than Intel or GE of long
seriously,
ago.
Just absolutely unreal. We'll touch on that a little bit more later. Switch up the board. Underperformance in big tech. NASDAQ futures down 0.4%. I want to get to the bond market. A lot to talk about around Chairman Powell and what he had to say about rates and the relationship between rates and asset prices. There's no correlation. Next time someone comes on this show and talks up markets based on where rates are, let's play the Chairman Powell sound from yesterday. We'll do that on repeat for a few months. Yields this morning, your 10-year unchanged, 1.0127%. Yields unchanged on a 30-year at about 177. That's the bond market. Let's finish on foreign exchange. Going to make this really boring for you. Euro dollar, 121, unchanged on the day. Tommy, you want the price action, it's clear. You've got to go elsewhere.
You got to go elsewhere. Let's go to GameStop. Almost through to new highs moments ago. It didn't get there. Above 500 a share. Right now, just below 490. But there's a persistency to the bid. I did not speak of the moment yesterday. That's a nice chart on radio. I love that intraday chart on radio. It works. Both hands on the steering wheel. Yesterday, I did not speak to GameStop too much with the managing director of the International Monetary Fund. She wanted to talk about the pandemic and the new inequalities that the International Monetary Fund sees. With our year ahead at Bloomberg, Kristalina Georgieva.
We are bringing our 190 members together last year to come up swiftly with the right policies for this very unusual crisis. And this year, to march together for the recovery from it. There is good news. We now have vaccines, and monetary and fiscal policy have done their job to put a floor under the world economy. But we also are under the thick clouds of uncertainty. And what we look into for the next year are first the race between a mutating virus and multiple vaccines. Second, the resolve of policymakers not to withdraw support prematurely. We have to see the health crisis in the rearview mirror before we do that. And three, a re-energized global cooperation so we can vaccinate people everywhere as fast as possible, and we can bring the global economy up for a more profoundly effective recovery rather than the uneven recovery, unfortunately, we foresee.
I think, Dr. Georgieva, my good friend David Malpass, now at the World Bank, would suggest you are more qualified than anyone in the world to understand the systems analysis, the processes of, say, the World Bank or the EU, and now at the IMF, of getting the job done. What are we not doing right now that we need to turn around and do correctly?
But the very first we need to focus on is a recognition that vaccine policy is an economic policy, and that only vaccinating everybody everywhere would get us out of the risk of this mutation that we have already seen threatening the hopes for accelerated recovery. And that is possible. Not only it is possible, it is in the interest of everyone. We did a calculation at the IMF that if vaccination is indeed accelerated around the world, we would get $9 trillion bigger global income, and that $9 trillion between now and 2025 will be split 60-40 between emerging markets, developing economies, and the advanced economies. So it is a great value for money action from advanced economies to give a helping hand to the developing world.
You've got
and
such
the second issue.
No, please go ahead. Please, Dr. Georgieva, go ahead.
And the second issue that we need to zero in on is something that I'm very, very concerned about. It is a growing divergence within countries and across countries. What we see is that parts of the economy, high-tech, digital, no-contact manufacturing, is doing extremely well. And people there are flourishing. And parts of the economy in the contact-dependent sectors, low-skilled workers, women, young people, minorities, they're doing very badly. When you take this problem globally, advanced economies are pulling out of this crisis much faster. Poor countries are falling behind.
Kristalina Georgieva, the IMF, really heated yesterday on the pandemic. As an environmental economist, I thought she really had a great perspective. We didn't have time to get to the Europe that John Farrell's been talking about, but there it is. John, you know, just a lot of information flow come out. American Airlines gets it done. American Airlines back to a pricing of about late February. That's fascinating. John?
It's absolutely incredible, Tom, to see some of these airlines snap back the way they have, and we hope travel can reopen. We hope this country can get vaccinated quickly. We've got to get to Steen Jacobsen this morning, Saxo Bank CIO, waiting patiently. Steen, I'll just kick things off. Your take on the last couple of days in this market, please.
I think it's super interesting, and I think it plays into the bigger narrative that's in place that we have a social revolution going on between the haves and the have-nots. In the words of the people who play the stock market, the Wall Street suits and the retailers, we have a Fed that continues to play a game where they ignore facts. I guess Powell's next statement would be that the world is flat, or that gravity is something that was invented in terms of fake news. And finally, I think most importantly, we have the fact that Fed needs to stand up one day soon, together with the Treasury Secretary that is incoming, and realize that the financial repression that goes on today creates a market which is, in its nature, is a one-size-bet with the market at all times. So you have created, by virtue of this extended policy and a look into the future of even more extension of the same policy tool with the financial repression, you have created a betting market.
A betting market. And just to fill in people who did not hear Jerome Powell yesterday, you are throwing shade at his comment where he said, if you look at what's really been driving asset prices, really in the last couple of months, it isn't monetary policy. The connection between low interest rates and asset values is probably something that's not as tight as people think. Steen, given that we are in this betting market, do you think that this populist shift, this anger that you're talking about that seems to be a hallmark, whether in actuality in terms of who's doing the trading or at least in the sentiment on these chat rooms, how else will it be expressed in markets? In other words, is this going to be a pervasive feature that does affect where prices end up going?
It does, and it already done it. Of course, you're all aware of a few hedge funds that's been in trouble. And if you look at the whole construction inside the fund management business of long-short portfolios, if you have and attack the list of the 50 most shortest stocks, you're also attacking the nominal names that everyone has in the short portfolio of the big hedge funds. So we will see, and we saw yesterday, in particularly in the green transformation space, the energy space, that a lot of names came down 15–20% inside the day, simply because the collateral value of the shorts blew up, or the lack of value in the shorts blew up, and they need to sell collateral against it, meaning that they had to sell the profit position. And I think, Lisa, it's very important to note that we had, in percentage term, the single biggest move in VIX yesterday we've ever seen. Not in nominal terms, but in percentage terms, which is a clear indication. And for the record, if you look at the curve in the VIX futures, the indication of what is to come, we have seen that the front-end contract is now, of course, aggressively being priced relatively.
Steen, part of your charm is, unlike a lot of CIOs, you have massive trading experience of enjoying the bid walking away. The challenge is a bid, and you can't find an ask out there right now. I want you to talk about about what we're seeing, hedge fund short, retail, the guys on the couch, and I think they're way more sophisticated than people think. But I want you to talk about the cost to short. The big guys clear their short. Everybody else is reshorting GameStop right now. And the so-called borrow to short is immense. What does that signal to you?
It signals that, you know, if there's one component of the market, which, and I agree with you, Tom, we have to give credit to these people in the retail space. Not only are they going after the short names where the vulnerability is because you have to deliver these stocks back to the owners, and they can get called on that, so they have, you know, a counterparty risk. But they're also using the optionality, the convexity of option, which translated into plain English means that they're getting a massive leverage of just buying the nearby calls. And don't forget, this is a generation of people, young people, who primarily probably came from the betting industry. In the betting industry, the probability on a bet is at best 50 minus the house. Now they're aggregating their voices, their money in a game against the short interest, as you allude to, with a game that says, you know, we are playing this like a lottery ticket. We can buy the calls forever, and we will lose, as we always done in the betting, you know, 40, 50% once in a while, but as long as the gains outweigh that. So we have changed the dynamics. And I think for us old suits, as they call us, we need to realize that the game has changed, and I have to go back to Fed because, sorry, Jonathan, I just want we have to go back to Fed. It is a repression market. We have the repression of the markets. We have no price discovery. Of course, we get to a betting situation.
Well, let's add to that. For Chairman Powell, when's it really get on his radar, Steen? Because in the last 24 hours in that news conference, that was just a shrug of the shoulders. We've got bigger things to worry about.
And they do, and absolutely. And I think probably also we should give credit to Powell to then connecting it to the full employment mandate that he's trying to operate. He put it in the context that despite the fact we run a very low interest rate and we have, you know, on hold for at least into 24 in terms of changing to that interest rate, we still have 6 million people who are unemployed. So the market disagreed with Powell on the fact that you can go back to a model where you have full employment. And for the record, you know, if you ask any futurist, anyone who wants to look into the future, they all expect that by 2030 we'll have 25% people, maybe not unemployed, but deployed alternatively. So creating a model now that drives towards full employment, full capacity, under the headlines of the technology and of course demographics going the other way, I think just makes up a huge policy mistakes incoming.
Steen, I love what you said there about the conflation here of quantitative finance and literally Ed Thorpe-like betting over to people trying to play a game, as we heard from Vallier, the hunter being hunted as well. I want you to conflate Paul Wilmot of Imperial College, the great Nassim Taleb, and also what we heard from the legendary Ed Thorpe, which is it's okay to take a loss. I know I'm going to take a loss, but I've got the upper hand right now. Explain that. Yeah, so it's really optionality. I mean, the crypto space is another example. So let's use crypto as an optionality on its thoughts and these comments. If you play the game of crypto, you don't even need to understand crypto. You don't need to understand stocks. If you are betting every time 5% of your wage, 5% of your total amount, and you have an optionality that says that once in a while you get a 50, 100, 200 payback on that exact bet, then you will always be ahead because you can control the destruction of your capital relative to your earnings. So you have a very, very high optionality game in the market. And that optionality, of course, is being not only supported, but being extended in terms of guarantees, the length, the depth by the Federal Reserve, who, of course, has a different agenda, but one of the unintended consequences being that to support that very optionality itself.
Steen, always great to catch up, sir. Steen Jacobsen, Saxo Bank CIO. Steen, thank you very much. Tom, I think the big frustration for me over the last couple of days covering this story has just been the amount of snobbery involved in some of the coverage of it.
Yes, don't get me going.
Well, let's just get started now. We've got a couple of minutes. I think it's ridiculous. Why is it okay for really wealthy individuals who are running funds to come on networks like this talking about their book every week? Why is it okay at the height of a crisis with the market crashing for them to go on air and basically start crying and then behind the scenes start covering their shorts? Why is that okay? But it's not okay for some real retail investors to talk about where they're positioned, what they like, and what they don't like. Look, I'll let the legal issues be dealt with by the lawyers, Tom. I just think the approach in general, there's just this huge amount of snobbery to it that's, I just don't think's right.
I think one of the great things I mentioned Nassim Taleb there, and you see it back to his classic fooled by randomness, is just what you're talking about, John, the elites being caught off guard. I'm not going to say anything about the hedge funds, but I really, really take issue with the boys on the couch idea. These are, you know, dumb people, lucky people, they're unemployed, they got nothing to do. I'm sure there's element of that within any large group. But these are sophisticated people who said, wait a minute, look at the short interest on whatever the stock is, let's go. I just refuse to believe the tarnishing of the boys of the couch that's going on worldwide
Couldn't agree more, and I hope that after this, we just get away from calling it dumb money.
I don't know, it includes Lisa's kids, so it's important.
How much of the smart money were on this program 12 months ago talking about the crash that we would see 2 months later? How much of the smart money came on this show in late March, early April and said bye, bye, bye? Not many, Tom. Not many. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. Fed Chairman Jerome Powell says we're a long way from a full recovery. Powell pledged to keep the central bank's monetary spigots wide open to help an economy hurt by the coronavirus pandemic. He brushed aside concerns that the super easy stance will lead to a stock market bubble and too high inflation. President Biden will make it easier for Americans to buy health insurance during the pandemic. He's reopening the federal Obamacare marketplace with an executive order today. A 3-month special enrollment period will begin February the 15th. That will offer a path to health care for people who lost their insurance when they lost their jobs. And the Republican Party will not automatically back Donald Trump in the 2024 presidential race. The chairwoman of the Republican National Committee, Trump loyalist Ronna McDaniel, tells the Associated Press the party has to stay neutral during a primary battle. McDaniel says what she really wants now is for Trump to help Republicans win back control of Congress in 2022. And British Prime Minister Boris Johnson is trying to quell support for another independence vote in Scotland. Johnson has stressed the backing his government has given Scotland during the coronavirus pandemic, and the Prime Minister visits there today. Toyota has once again become the world's best-selling automaker. The Japanese company overtook Volkswagen to clinch the top position for the first time in 5 years. Toyota sold a little more than 9.5 million cars in 2020. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
If there's a significant increase in chatter on a particular company or a particular situation, then we actually can flag that and then compare that against the trading activity. And if we think that there's something unusual or, even worse, nefarious going on, we can halt the stock.
That was Adina Friedman, the NASDAQ CEO and president, speaking with us at the Bloomberg Year Ahead Conference from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures down about 0.1% on the S&P 500, negative 4 points. Euro dollar unchanged at about 121-ish, comes at 0.1%. No big moves here. In your bond market, yields unchanged at 1.011%. They're the moves.
John,
35,000 feet for you, Tom.
Yeah, translate the German headlines, please. We're on this. Let's do it. I mean, we got all this GameStop malarkey we're talking about. Come on, this is serious stuff out of Germany.
So we're talking about a vaccine from AstraZeneca that at the EU level still has not been approved, and there have been some conflicting reports through the week about the efficacy of this particular shot. We'll get to that question in a minute. There's been the reports about the efficacy of this particular shot for the elderly and some pushback from some parts about how effective it would be for people over 65. Germany is recommending this vaccine shot for only ages 18 to 64. This is coming out of Germany at the moment. So as I say, Tom, at the EU level, this is a drug that still has not been approved, but the recommendation coming from Germany at the moment is that this shot will only be for people aged 18 to 64.
I make jokes, folks, but this is not funny. It's really, really extraordinary to see. It's really a lot of good scientists race on the vaccines from many, many different companies. Shannon Cross writes blisteringly straightforward, tech reports. They're wonderfully clear. I love when it's 7 pages. It's actually 7 pages and not filled with a lot of fillers. She's with Cross Research and joins us now. Shannon, off of Microsoft and off of Apple, let's just start with the big tech. What have you learned?
Well, I think what we've learned is that certainly the consumer has been extremely resilient. iPhones were up 17% year-over-year. PC sales were very strong at Microsoft. And I think we've also learned that the cloud is a big focus. Services within Apple, which were up 24%, were driven partially by the cloud services they have. Obviously Azure was up 50%. So right. I think both of those trends are strong. Enterprise a little weaker, or not a little weaker, but it remains a little bit shakier, I would say.
In the game of extrapolation, what is your conviction out 2 years or 5 years on these names? They're getting a pandemic pop. How do you recalibrate your conviction out 2 to 5 years?
I remain really positive on both of these companies. I think, Apple they have 1 billion iPhones out there in their installed base. They have 1.6 billion devices that people are utilizing. Their services continue to grow. They're spending, aggressively in R&D, which is continuing to support their product pipeline. They came out with their AirPod Maxes. They're continuing to be sold out. Some of these products don't necessarily move the needle a lot, but in aggregate they do. For Microsoft, I think Azure is quickly becoming, one of obviously the top choices from a cloud perspective. Companies continue to shift to cloud services like Office 365. And, the interesting thing about PCs is that a few years ago, everybody said they were dead and everybody was going to go to a tablet. Now the PC companies are all talking about 1 PC per person, not 1 PC per household. So there's still a long ways to go in terms of PC adoption and penetration.
Shannon, can we just take a step back? The shares are lower today because they didn't provide a forecast, and yet they had a revenue for the quarter of more than $100 billion, surpassing revenues for full years as recently as 2011. And people are selling the shares because they don't have visibility in the near term that they're going to absolutely crush it the same way that they have. There is a question of what they have to do with their money, with all of that cash, in order to keep crushing it at a time when Facebook views Apple as potentially its biggest competitor, and Volkswagen views Apple as its biggest competitor with iMessage and the Apple Car, respectively. Is Apple investing its cash in enterprises that will lead it to that dominance in those particular industries in a different way than it is now?
Well, I think Apple's running the playbook they've been running for several years, and it's clearly worked very well. So I don't think they need to go and buy something, and be aggressive from an acquisition standpoint. You look at their R&D spend; it's significant. We hear chatter about autos. They're obviously investing heavily in healthcare. I'm not sure that they need to really change what they're doing. If you look at the trajectory of the revenue, last year they did $274 billion, and this year we have them doing $332 billion. The numbers are staggering. I still remember when they gave us a model that said, we're going to do $8 to $12 billion over the next few years annually. So it's working. I think that they will come out with, they've always said they will come out with products when they're ready to release them, and they're the best product out there. They weren't the first product on PCs. They weren't the first product on iPods. They weren't the first product on tablets. And yet they've come out, and iPhones, I would say, you can make the argument there they were out first with the product they had. But, they've continued to take significant share and become dominant leaders in the categories. And I think we will see that again in some of these other products. But it will take some time.
Shannon, we got to go. There's an airline going to space. Shannon Cross Research CEO and analyst. It's American Airlines this morning in the pre-market, up a cool 58%. In early trading, Tom Keene. The CEO out this morning basically shrugging their shoulders in the C-suite, saying we don't know when demand returns. The loss is narrower than expected, but the stock is absolutely flying.
Dare I ask, is this being moved off the couch?
Maybe. And if it is, we have to process that. That's a market. Supply, demand, it clears at a given price. You've got to process that. There are implications elsewhere. We've got to work on that.
John, what we do is we go to the charts here, and as I said earlier, I don't believe with this surge you've just quoted, we're back to late February levels before the terrible March drop. And,
well,
who knows?
Here's
Lisa?
the thing I find really interesting. We're talking about Apple absolutely crushing it on the revenues, having a record-breaking quarter. That's the reality, and people are selling the reality. They are buying the hope. American Airlines not necessarily seeing such a big pickup in their summer bookings. It's not like everyone's going and flying around anymore, but people are pouring their money into hope. Interesting also a note from JetBlue's fourth quarter report, John, and I found this compelling because I'm looking for cheap tickets when the pandemic ends. They actually increased the price of fares, bucking the trend in lowering the prices in order to lure more people. We are going to see more of this. They have to plug that gap with respect to how much debt they have incurred to survive this period of time.
I am JetBlue Mosaic. I have some JetBlue points for you.
Do you?
If you want them. Where would you like to fly to?
I mean,
John,
how was Capri?
Your Alitalia points are just unbelievable.
I can't do anything with my Alitalia points right now. Let me tell you that. Andrew Sheets is coming up.
The view he had in Capri.
Of Morgan Stanley. Tom Keane causing trouble for another hour on this program too. American Airlines up 53% in early trading. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport industry
buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
There's clearly a bit of froth.
Markets are kind of treading this very fine path between stimulus optimism and virus pessimism.
As long as equity prices are high enough, everybody's happy. But we can't do this forever.
The institutional players know what they're doing here. It's the retail investors that could end up getting hurt.
We have a massive wealth rebalancing going on right now in the world.
Not every company can be an Apple or a Tesla. And I think now people are looking for stuff that probably doesn't really exist.
Next year, when things start to look more normal, then you're going to have the hammer come down on some of those companies.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thank you for being with us on radio, on television, at your local GameStop store. Thrilled you're with us today as we look at, yes, the story of the moment, but many, many other stories around challenging pandemic news and also companies adapting and adjusting to the news. John, let's stop it on GameStop right now. It was above 500. It's below there. Frankly, it's elegant and churning intraday. And let's look at the reality. And John, might I suggest the celebration of airlines in recovery?
American Airlines, if you want to see a short squeeze, look at the pre-market action in American Airlines this morning, up by about 82%, absolutely flying. You just wonder if that's the name of the day to replace what we saw yesterday in AMC and GameStop as well. We've talked a lot in the last hour, I think, about retail and push back against the immense snobbery in the conversation at the moment. Not all retail is equal. Here's the part of retail, so to speak, that I do worry a little bit about, Tom, and I know that people have reached out to us this morning about this very topic at the moment. You've got the institutional players, not all created equal. You've got the retail players, not all created equal. The people actively engaging this market on the retail side right now, they're informed. I think many of them know what they're doing, Tom. The people that are passively allocated to this market at the moment, and that's what people have written in about us, about this situation this morning. GameStop is now number 2, granted just 0.75% of the Russell, but still number 2, the number 2 weighting in the Russell 2000. So if you get people coming on the program talking about allocating as small caps, about this rotation and just being passive, handing your money over, maybe it's going into your pension fund. Your number 2 holding now in the Russell, Tom, it's GameStop, which is a battle between institutional money and those looking to squeeze those shorts.
I take the point, and I'd also point out, John, there's a second and third tranche of retail that gets in that is less sophisticated than the first tranche that gets in. I want to make clear one of the great mistakes is to say retail is dumb. I flat out disagree with that. There's a lot of smart people out there, and John, I'm sure they're buying cottages in Capri like you were looking at on your last trip there. I do want to point out, and this is an advantage we have with the Bloomberg terminal, short interest on American Airlines is substantial. Not GameStop, but Lisa Abramowitz, 25.5% on American Airlines. That was a bet against the airlines.
Yeah, which is part of the reason why people are attributing the 74% surge in their shares that we have seen pre-market after American Airlines reported earnings. They weren't that great. It's just that people are saying, could this be the next GME? Could this be the next GameStop? And this is what Reddit is sort of hinting at as we look at the shares increase. I do want to say, though, just picking up on John's point here, there is a real conundrum for regulators, and he was talking earlier about Senator Warren and her comments. How do you protect the little guy if the little guy's winning? And right now, the little guy is winning versus the big guy. That's at least the narrative. And that you've got the big hedge funds that are imploding, and you have the smaller retail investors that are cashing in. As the SEC, how do you go to your point, Tom, and say those follow-on traders, the people who get in after, how do you protect them if the little guy is doing just fine?
And very importantly, folks, I mentioned Ed Thorpe earlier and all the mathematics of this. It is incredibly important to understand that on a given single-way trade, in this case, long GameStop, long Faro International, whatever. Actually, the company was Amalgamated Faro from the 19th century. The gains and losses are not 50-50. You can have 20% or 8% or 7% of the people capture the gain, and Lisa, to your point, everybody else loses money on the way out. Andrew Sheets studied this at Brown University. We're going to get right to him. Futures -13, the VIX 33. Andrew Sheets, let's open up, and I don't want to get you in trouble with Mr. Gorman. You're really good at this mathematics. Your thoughts on this moment as the hedge funds get clobbered?
Well, I think it's important to separate that there are a few overlapping storylines in this market.
Please.
There's a storyline around the strength of the recovery and will there be issues or delays with the rollout of a vaccine. And then I think there's a separate discussion now around the concentration of positioning, which I think has been a discussion now for some time. I think this has been a very unequal market for years, really, with very uneven valuations across sectors, across styles, and very uneven positioning among active investors to try to take advantage of that. And so I think it's important to separate those things out. And ultimately, in my view, the macroeconomic picture still looks good. We at Morgan Stanley are still very constructive on the growth backdrop. And that makes us think that this is a more modest adjustment rather than some larger challenge for the market.
Bear with me here, Andrew. I want to think this out with you live on air. I just wonder if the conversations that you and I have been having for the best part of the decade need to change. We see market moves. We talk about the stories that are driving those moves. We often draw a line back to the fundamentals, the outlook, the story, so to speak. And I just wonder sometimes at the moment, particularly I think back to late August, early September, that maybe it's just this explosion in short-dated call options and it's the tail wagging the dog, and we all sit around trying to come up with these fundamental reasons for any given move in markets because that's what we've done for decades. But I wonder, Andrew, whether we just need to change our approach in the way we actually consider what's happening around us and the way we talk about the price action.
Yeah, look, I think that's a very good point, and I think this is a case where more than one thing can be true. I think it can be true that you're seeing an unusually large amount of retail investor activity, of call options activity, that you're seeing, an unusually large amount of liquidity that's going into the market. And yet, viewed, I think, from other lenses, the market is behaving and has been behaving for some time, I think, in a very rational, fundamental way. My favorite example is, if you look over the last decade, the market that's performed the best by far has been the S&P 500, which has had the best earnings growth by far of the international markets. And so it's not the case that, the S&P is only up because, rates are low or the Fed is doing QE. The S&P has had significantly superior earnings growth to those other major markets. So I think it's a case of kind of both things can be true. You can have shifts in market behavior, you can have changing patterns of behavior, but I do think overall those broader fundamental trends remain intact and remain important.
Andrew, I love that you started by talking about the different narratives going at the same time. It is a very difficult market to sum up in one word. One of the narratives is the concentration of markets, and we're seeing this both on a specific stock basis as well on as a consensus view perspective as well. For example, coming into the year, the weaker dollar call was very much consensus. The higher rate call was very much consensus. Both of those have been turned on their heads in the first few weeks of 2021. How important is it to look at the concentration of positioning and move against that in order to avoid such violent repositioning going forward?
Yeah, I think this is a really important point. And again, I think a theme that interestingly varies across markets. I think we find there are some views where I think we're in the consensus. We, like a lot of people, think interest rates in the U.S. go higher. There's some areas where I think we're out of the consensus or think somewhat differently. We're not in that weak dollar camp. We think that the equally weighted S&P 500 will outperform the S&P 500, i.e. you'll see a broadening of the market and underperformance of some of those larger weighted stocks, as often happens coming out of a recession. And again, I think if you look at some of the recent price action, again, I think this is an interesting thing an interesting or important way to diagnose what's going on. Is what's leading the market the most widely held stocks, or is it the more economically sensitive ones?
Andrew, we're all students of the mop-up books on all these crises. I think of Stanley Fischer's classic book on 1998. Andrew Sheets, in the derivative space, whether notional or the small amount of actually derivatives issued, traded, however you want to phrase it, what are the shadows out there? For a guy like you, what are the unknowns or the mysteries of the derivative space right now?
So I think this is quite fascinating, actually, because even a week ago or 2 weeks ago, when things seemed much calmer, the equity options market was still expecting quite a bit of volatility at the overall index level and was quite worried about a larger drawdown, right? That skew was historically very steep. And so I don't think this is a case where you could say the market was completely blindsided. There was, an elevated amount of uncertainty expected by the options market. And then what we saw yesterday was an even larger adjustment of that. You had a much larger move in the VIX than you did versus credit or other asset classes. So, and I think that also speaks to the positioning nature of it, that this has, I think, the hallmarks of a VAR shock or a kind of a positioning shock more so than a real economic shift in view.
Well put, Andrew. Interesting take. Andrew Sheets there of Morgan Stanley. Andrew, great to catch up, sir. 2021 will be a year of recovery. Doug Parker, the CEO of American Airlines there. Get a stock up this morning. Pre-market, Tom. Up about 57% now. Bit calmer. A little bit calmer pre-market on American Airlines.
It's a moonshot. I don't want to get technical here, John, but and this is, frankly, why the Bloomberg is so good. You look at it, folks, within bar charts on 1 minute basis or 5 minute basis is sort of non-granular. And John, it doesn't look like GameStop. It's just one massive short cover. I mean, it's all there is to it.
It's a squeeze, Lisa.
Yeah.
It's a squeeze. The question that I have is, at what point is this fundamentally going to be challenged? In other words, will there be a moment where the gas gets removed from this balloon, or is this something that could be perpetuated in an era of monetary policy?
Right.
I mean, Jay Powell might disagree with this, John, but I think most other people wouldn't.
John, I want to partition that. It's so important. A short cover basically says they're getting out. The shorts are saying, forget about it. Where your correct phrase, squeeze, is where the longs are pushing the shorts out. On American Airlines, I just see the shorts getting out.
Chairman Powell, yesterday, I think he just gave a green light for everything to carry on as is.
Which is what he wanted.
Oh, he didn't address it. McKee was rude. I mean, McKee,
Well, when is Mike polite?
Yeah, exactly.
Come on. There's a reason he used to go first in the news conference. He's made his way all the way down to the bottom of the pack. Coming up, James Angel, finance professor at Georgetown University from New York. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The Federal Reserve is nowhere close to ending its massive support for the U.S. economy. That was made clear by Fed Chair Jerome Powell. Fed policymakers left their benchmark rate unchanged, near zero. And Powell told reporters it would take some time for the Fed to reach the threshold for dialing back its bond buying program. In a span of 2 weeks, states in the U.S. West have seen the number of coronavirus cases go down by an average of 43%. That outstrips the decline in other regions. Improvements led California Governor Gavin Newsom to ease social distancing measures earlier this week, but that could lay the groundwork for infections to spike back up again. China's President Xi Jinping is signaling that Beijing will tighten control over Hong Kong. Xi says the semi-autonomous financial center must be governed by what he called patriots. Xi told Hong Kong Chief Executive Carrie Lam that having loyal leaders was the only way to ensure Hong Kong's stability. Lam's term expires next year. And shares of Apple are down. Pre-market executives came out with a cautious outlook, and that overshadowed quarterly revenue that topped $100 billion for the first time. Apple said that sales growth from AirPods and other wearables will decelerate in the current quarter. They also forecast slower services growth. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
continues to be, recovering well. And with the opening up that was decided at the last 5-year plan, that is a golden opportunity for many international banks.
So we'll look to double our footprint across IB and also wealth management and asset management in the 3 to 5 year time frame.
Growth outlook structurally is very strong, but it does need to consolidate and allow time to help the share price appreciation to move more in sync with the growth.
So China can avoid further decoupling if they stop these inappropriate actions.
But at the moment, we really want to see the dust settle first on international relationships, on China's role in the global economy.
I don't see a likelihood of a big change in the policy with the change of administrations.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Hedge funds had every right to be short of GameStop, but they should have noted the fact that there was more shares of GameStop shorted than existed in the free market. You're getting weakness in the broad market and strength only in GameStop. This will end. It'll end in the next week or two, but it's going to be ugly, and there'll be more than just one or two hedge funds that find themselves in the dinger.
Dennis Gartman there. You all know him as the retired editor of the Gartman Letter. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. American Airlines, the stock to watch this morning. Up and away, now up just 40%. On American Airlines in the pre-market. That's the story for that single name. Let's get to the story for the broader markets. Equity futures pulled back a little bit on the S&P 500, down 11. Unbelievable after the earnings slate of the last couple of days that they hardly get a mention. Apple, anyone? Microsoft? Nope. Tumbleweed. Euro dollar, 121 in the bond market. Yields down a basis point, almost, Tom, to about 1%.
12 minutes away, we've got the labor report. I think that's really important.
I couldn't agree more with you, Tom. Jobless claims just around the corner.
I was at one of my fancy breakfasts that I have where I hold court yesterday with the entourage, and I got a phone call. It's from Pharaoh, so I had to take it, of course. And he's screaming at me, Tom, forget about all these pundits. Get us a rocket scientist. So we came close. We've had a wonderful set of conversations. Mr. Gartman on the history of the moment. Steen Jacobson, I thought, was lights out at Saxo Bank. And now James Angel, he is at Georgetown, Jim Angel. And what's so important here is he is a rocket scientist. His engineering out of Caltech, his brilliance in mathematics at Berkeley, among others. And we're thrilled that the finance professor could join us this morning. I've got to go, Jim, right away to you with a Bloomberg down the hallway at Georgetown about whether you're participating in this. Have you enjoyed being long or short GameStop?
Well, I was long until yesterday, but when the stock went crazy, I decided to go short just a little bit, although I see that it is doubled overnight. So I've proven to myself once again I am a lousy trader.
Now, we need a booker here on surveillance, so if they throw you out the door at Georgetown, you got a job up here. Jim Angel, if that's the reality, are you worried that the people on the couches are dumb, or are they as sophisticated as you are?
I'm sure they're more sophisticated than me, that's for sure. But, I mean, what we have here is a confluence of events. You know, we have the mother of all short squeezes going on. At the same time, we have a retail herd, but I'm also hearing that hedge funds are jumping on board. As one hedgie told me, he said, hey, when the herd moves through the gate, get on a cow. So I think what we're seeing is this move is being amplified by other hedge funds that are jumping on board. They smell the blood in the water. They can see that shorts are overexposed, and they're playing a game of musical chairs to ride it until it turns.
Well, but Professor Angel, this goes to a broader issue here, which is the question of democratizing the market, allowing smaller traders to participate in a rally that has been unprecedented and phenomenal in equities fueled by policies versus protecting the individual investor from institutional investors who are manipulating the herds to do their bidding, right? And that's sort of the question. How do you distinguish one from the other?
It's very hard. There's no easy way. Personally, I think investors should have the right to invest in anything they want. So I'm very leery about people who want to protect people from themselves.
You're leery of people protecting people from themselves. In other words, you think that there is nothing wrong with what's currently going on, and you disagree with Senator Warren in saying that the SEC regulators do your job, get involved, because there is nothing for them to do. This is just markets the way that they ought to be running. Is that correct?
Not completely. There are things the regulators should be doing. They should be investigating what's going on, because we see a stock price that is clearly disconnected from reality. And who's driving it? Now is a test of the new consolidated audit trail. It's not fully up and running, but it's partially running. Let's see if it's giving us good data. Also, what's causing this short squeeze? This is not the first time we've seen these kind of spikes in prices. And let's face it, an overpriced stock is nobody's friend. When the market or a single stock is overpriced, all you're doing is locking in future losses for investors when that stock comes back to its proper level. So we don't, super high prices are not good for anybody. Now, the SEC should also be looking at imperfections in the market that are driving the short squeeze. I think we need improvements in the Customer Protection Rule 15C3-3. I think we also need to upgrade Rule 204 on regulation SHO. These are things that I think can be done to improve customer protection and smooth out some of the wrinkles that are leading to these kind of price spikes.
James, terrifically smart, and we appreciate your time, sir. Please come back soon, Professor. James Angel there of Georgetown. I've got to get through the next 20 minutes and stay out of trouble because we're drifting towards the politics a bit here, so I'll put the statement as a question and try and avoid that trouble. What is it about people on the left that just assume everyone should be protected? What is that about? Why is that the starting position of everybody on the left? And I'm talking about Senator Warren here. Do you hear that from the retail investors putting these trades on? Do you think they want protecting? I don't hear that from them.
It comes, John, out of the Depression. It comes out of 33, and when they did 33, they had to fix 34. This is 1933 and 1934, folks. And at that time, it was economics, and it was to protect people from what was clear manipulation. We're a lot more sophisticated now, and to your point, John, there's a lot of people out there enjoying taking losses as they search for gain. And your question's really well put in that you've got to have some pain out there. I would say, as we heard from Professor Angel, you've got to have transparency, visibility. And when I look at the Bloomberg terminal, and I didn't get to this with James Angel, when I look at the Bloomberg terminal, John, I see a healthy bid-ask drift on something like GameStop.
Yeah,
it looks normative.
I'll be totally transparent. The legal issues are way over my head. These are just questions. Michael Batnick writing on his blog this morning, when Wall Streeters take advantage of the system, it's called capitalism, but when outsiders do it, it's called manipulation.
Well, here's the thing. There are many different issues here, right? First of all, the question is, are there hedge funds, are there institutional investors that are trying to push the masses into one thing or another? And then what's the consequence of what James Angel was saying, the basically high stock prices eventually being a very bad thing, and those stocks suddenly having a very big proportion in the indexes that, all of the retirees and pensions have all been invested in. It creates a problem, a sort of systemic problem for markets. I think that you raised a good good point. This idea of protecting people from themselves while also democratizing markets and letting people play in this is a really serious issue. I don't think it's just in the left. I think it's the populist idea versus sort of a more, traditionalist approach. And I think that that's being challenged on its head. But John, the real question is, how do we get to the bottom of what the actual dynamic here is in terms of who's doing what?
Yeah, but on the issue of the politics, this is a left-wing issue. And it comes with some snobbery, it's some highbrow stuff, and it's often made by left-wing politicians that have got so much money, and then they talk about the elites and they're there to protect the normal people as if they haven't made the millions of dollars themselves. And you guys know what I'm talking about. From New York this morning, good morning. This is Bloomberg.
一个就是我们看中它的那个品牌吧，它品牌就是说东西比较干净嘛，然后比较方便的话，味道也还可以的话，我觉得我会考虑吧。外卖的话呢，也是一种方式，就是品种会多一点嘛，各有它的特点吧。
这个车的话，目前我们是通过这个手机 APP 上，就手机扫码，然后微信和这个支付宝扫我们这个车上的这个二维码，大家就会进入到一个小程序的这个界面，然后呢就可以选购自己喜欢的商品，然后付款之后呢，这个柜门会自动打开。
支付成功，请拉开右侧车门取货并关紧柜门。
然后我们会取餐，然后完了之后呢，就把餐这个柜门关上，然后整个购买的这个流程就会结束。
柜门已打开，请取出货物并关好柜门。
From New York City, for our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. Let's get to the real news of this morning. It's the economic data, the unemployment, the jobless claims in the United States of America. With the numbers as they pour out in the United States of America, Here is Bloomberg's Michael McKee. Good morning, Mike.
Good morning to you, John. We're waiting for a lot of numbers this morning, and unfortunately, all the sexy ones are a little bit delayed because everybody has to go on the internet and get them. We do have the advanced good trades balance comes in at 82.5 billion. The forecast was for 84.8, so that does suggest, this is for December, that we're going to see a little bit better trade figures in the GDP report when the numbers finally do cross, when we can finally get into this, and that suggests that maybe growth is a little bit stronger. We're also looking for jobless claims, and jobless claims come out at 847,000 for the week of January 21st, last week. And basically what we're seeing here is a decline in the number of claims by 67,000 from the previous week, which is good news. We are out of the holiday period, so we are seeing some maybe more accurate data. Still have all those concerns about double dipping and fraud and things like that. But the numbers come down just a little bit. Still, 847,000 is an awful lot of people who are still looking to find employment. The GDP number is out now. At least we've got the headline. Right now, it looks like the BEA's server has crashed on the overall numbers.
They're all going short.
GDP comes out at 4% for the third quarter. That is below the consensus estimate of 4.2%. And for those of you who have been paying attention, way below the Atlanta Fed's 7% prediction. 33.4%, of course, was the third quarter gain as we rebound. So this 4% is a smaller rebound. We don't want to say that it's a recovery yet because we're still well below the numbers that we were anticipating in terms of that we would have been at right now.
Mike, let me take time to get a question while you try to digest the slow motion release of data. We're sorry for that, folks. It's not the norm here at all. Mike McKee, is the data now and the rebound still noisy where you basically don't trust it, you can't get a trend, you can't get a vector, or are you beginning to see a stability in the many different data points where you can make a guesstimate of where we're heading?
You're not seeing enough stability, enough information yet. We are still trying to figure out what the economy is going to be doing. The latest estimates that we have in terms of higher frequency data is that growth is about 0 in this first quarter. So the real question is how quickly do we start to ramp up? Getting a little more here, the increase in GDP, the 4% reflected increases in exports, non-residential fixed investment. So business spending is still rising, and consumer spending rising. I'm looking for numbers here. And
we'll let you keep looking.
Not finding it immediately yet. The PCE index on a quarterly basis increased 1.7%. We really don't care so much about that, but we are seeing the rebounds start to come through here.
Well, I will say, Mike, we are getting some more numbers, and one of them is personal consumption, which has come in below expectations. And Mike, are we getting any sense from this data as we look at another round, another week of near 1 million people filing for unemployment, of who these people are in terms of what jobs they hold, in terms of their income brackets?
We do know that the people at the lower income brackets have been the ones who have really lost their jobs and lost income. There's probably a combination of things happening with the drop in personal consumption to 2.5%. It was 41% gain in the third quarter. And that is that people are not just losing jobs and don't have money to spend, but also the people who do have money to spend aren't spending it. They're being more cautious. They're saving. Whether that's because they're concerned about what is happening in the economy or they just don't want to take a chance on going out and spending is the open question. And I think Jay Powell said it again yesterday, as he's said many times and others have, that it's really going to be the virus that determines. When people feel safe going out and spending, then they will start to spend more. And the problem is we're not at that point yet, and we don't exactly know when we're going to get there.
Michael McKee, thank you so much. Greatly appreciate it today. We'll digest the data and get more to you through the morning, of course, with Mike and our economic team. Frederick Mishkin came out of New York City, studied under Stan Fisher at MIT, and went on to a sterling academic set at Columbia University. Ahmad has passed as a governor of the Federal Reserve System, and we are thrilled on our new policy that Rick Mishkin could join us this morning. Rick, I've got a 2-hour interview ahead of me with you, and I don't have the time for it as well. Do you see the construction of possible policy in Washington, or is it going to be gridlock as we've known?
I think they're going to get some things done, but I think that there's going to be issues on some parts of what the Biden administration wants. So I think what they definitely will do, and I think do it quickly, is to get funding for more vaccinations, better testing, and so forth. I agree with Jay Powell on this, which is what's happening in the economy. It's really all about the COVID. That's the deal, that if we get COVID under control quickly, the economy will come back, and actually could come back fairly strongly because of all the pent-up saving. And, me and many others, the day that I can start traveling, man, I'm out there. I want to spend some money. I'd like to go out to restaurants right now I'm living the dream, and I want to live a much better dream in terms of after COVID gets more under control. And I think that's really the key. So I think that we are going to get quick progress on that. Where it will become more complicated will be on some other elements of this bill. I do think we're going to have some expansionary fiscal policy. Some checks will get sent out. But there are other elements of that legislation that may not get passed, particularly minimum wage and so forth. So we'll have to see. I think that's one of the key issues for the Federal Reserve and for the economy, which is the partisanship in Washington going to be a problem or not? Remarkably, it wasn't when the pandemic first occurred. What was extraordinary, within 2 weeks of the pandemic being declared, we had a $2 trillion bill from Congress. And it wasn't any less partisan then than it is now. So I'm actually optimistic that they'll do reasonable things in this regard. But I think the real key issue is going to be how quickly do we get the vaccine out? The Biden administration says by the end of the summer we may have everybody vaccinated. That would be good news if it happens. Then there's this issue of the variants. How effective will the vaccine be against the variants? Well, we have to have new shots in order to deal with some of these variants. So I think all of this is basically the key to what's going to happen to the economy. It dominates everything else.
Yeah.
And I think that's why the Fed is basically in a holding pattern. They're not going to tighten. They're not going to depart from their expansionary policy regime that they've set in place until there's really good information that COVID starts to get under control. And we don't have that yet. So that's why I think they're taking the position they're in, and why we're all waiting for hopefully better times, but we don't know.
Rick, allow me to jump in just quickly. You mentioned the speed, the pace of the snapback, the recovery. What is it about the nature of this specific shock that dictates the snapback, the speed at which we recover?
Okay, so what's actually really unique about this this recession, the COVID recession, is not that we have a sharp downturn in the economy, but that this is actually a case of where what we call a supply shock. The fact that basically there's problems in terms of production of certain types of goods, particularly things like that are service type industry, which involve one-to-one contact. The supply shock is driving demand. So indeed, the dominant thing is that people aren't spending, but it's not because of tightening monetary policy or something else. It's because of the fact that the COVID actually causes people not to be able to spend. So once you release that, once you get people back able to spend again, they've been doing a lot of saving. They're going to start spending, and probably spending very strongly, which will bring the economy back fairly quickly. The problem is until people feel comfortable with going and traveling, getting on an airplane, they feel comfortable with going inside a restaurant and so forth. This is going to actually be key to what happens. So I've just been vaccinated. So once I get the second dose, I'm going to be much more willing to go out and travel, for example. When that happens to everybody, that's going to be a big thing to affect their demand. So it's unique because what's happening on the what we call the supply side is actually driving demand, which is a very unusual situation, almost unique to this recession, because we really never had a pandemic recession before, at least in the modern era.
Well, congratulations on getting vaccinated.
Oh, yeah, absolutely. I'm free at last.
I know that's, I look forward to that day. There is a question, though, in the meantime, when people are sitting at home looking for something to do. They're trading stocks, and we've been talking about that all morning. And it's not just individuals, it's also institutions who are playing around with all of this money that has washed in. Jay Powell yesterday said, if you look at what's really been driving asset prices, really in the last couple of months, it isn't monetary policy. The connection between low interest rates and asset values is probably something that's not as tight as people think. Is that true?
I think in general, when you look at the data over a long period of time, that's basically true. There is an issue that there could be an interaction in terms of expansionary policy and what people call irrational exuberance. So there was always a concern about that. I actually think that people overdo their focus on the stock market as driving things. In fact, bubbles in the stock market per se are, and when they burst, are not really the problem for the economy. They can be dealt with. It's when it involves the credit markets. And that's what the thing that caused the problem in terms of the last global financial crisis was not the stock market, not the fact that there were changes in asset prices per se. It was the fact that when that happened, it really affected the credit markets and caused them to seize up. That's not where we are right now. So I think that people focus on the market. People can lose money. They can do stupid things. We can have bubbles. There are crazy things like what's happening at GameStop and so forth. But that actually very rarely has a major effect on the economy unless it interacts with the credit markets, which I don't think is what we're seeing right now.
Rick Mishkin, I don't want to go all Sandy Grossman, Joe Stiglitz on you, but let's go. It's a Columbia moment here, and I want to talk about the information's out there. Do we have too much information visible now, or are we still drowning out in the equity markets and in all our long, short, and all the silliness? Or is it still information we can't see? Are we drowning in visible information from all this trading volume?
I don't think we're drowning in invisible information, but there is an issue that the nature of markets is that sometimes people go a little bit crazy. I mean, that's just the history of financial markets. It was Charlie Kindleberg was one of my professors, delightful professor, by the way, quite a character. In his book, Panics, Manias, and Crashes. This is just what happens. People sometimes get a little nutsy. That's one of the reasons why you actually want central banks to be there to make sure that if there's people get nutsy, that central banks can actually come in to basically stabilize the situation if bad things happen. And actually, this is what the Fed has been able to do very successfully, particularly extremely successful in this COVID crisis. One of the things that people don't realize how lucky we are that COVID didn't occur 15 years ago before the last financial crisis.
Right.
Because it took 18 months for the Fed to figure out what to do. In this case, they did it in 2 weeks.
Okay, but Rick,
and that's extremely important in terms of the economy doing much better than it otherwise would have.
Rick Mishkin, just because of time, this is so important. And I want to move from Kindleberger over to Hyman Minsky, who darkened the door at Columbia, I believe, as well. Would you suggest that the distortions in derivatives, in calls, in puts, in a long-short hedge fund battle could be something our central bank will have to focus on down the road?
Again, I think that the issue is what Hyman Minsky was talking about was these credit cycles. That's really what we have to worry about, is these big booms in credit that crash. That's where we get into real trouble. Other bubbles typically are not nearly as important if they cover the commodities market. They do create some losses, but think about the following, that during in the precursor to the global financial crisis, there basically were losses about $500 billion in the subprime market that basically triggered the whole thing. So that was a credit market distortion with spread. If the stock market moves 1% or just a couple of percent, that's way more than the $500 billion. So stock market moves all the time, and yet it doesn't create these kind of problems. It's really when it's the credit markets that get problem. It's bubbles in the credit markets that we have to worry about, not bubbles in asset markets per se, although sometimes they do occur at the same time, and that's when you get into real trouble. And that's where I think that I have less concern now than I did, for example, during the global financial crisis, where the bubbles really spread very much into the credit markets, and that's where we were in deep trouble.
Rick, we'll have to continue this conversation on a credit market another time. Rick, fantastic to catch up. Rick Mishkin there of Columbia University. Thank you. Tom, bond market, a little bit of a lift. Yields up just a little bit of fraction. Yields to 1.02% on a 10-year.
It was a rich set of data, as Mike McKee mentioned. I went back nominal GDP at 6% is a pretty good annual spirit. I could cut it both ways. Let's remember, John, there'll be revisions as we go down the road in the recovery, as Professor Mishkin mentioned.
Claims are just too high, Lisa. They're just still too high, way too high.
The economy has been devastated. What I'm struck by, I'm just still thinking about what Rick Mishkin was saying about credit markets. And there is a question, if you do get this resurgence in spending and you do get a bigger than expected pop in inflation, will that make people reassess the bubbleiciousness of some of the credit markets? That is a very real question, John.
The risk to markets, better growth. Is that the...
Well, I mean, this is the conundrum. This is the conundrum, right? I mean, to Jay Powell's point, if interest rates aren't a problem, it won't be a problem. I think most people on Wall Street would disagree.
You know, I got to admit, John, with all of the distractions we've had with GameStop, we haven't had this week our quota of Abramowitz gloom. I mean, we're short on it this week.
Watching a clock. Don't worry about that. Every time you and I go, Lisa's like, I got this later on in the week.
Come on.
When GameStop is yesterday's news, Lisa, we're going to get a 10-minute monologue. Let me tell you something about that credit market. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Fed Chairman Jerome Powell says we're a long way from a full recovery. Powell pledged to keep the central bank's monetary spigots wide open to help an economy hurt by the coronavirus pandemic. He brushed aside concerns that the super easy stance will lead to a stock market bubble and too high inflation. President Biden will make it easier for Americans to buy health insurance during the pandemic. He's reopening the federal Obamacare marketplace with an executive order today. A 3-month special enrollment period will begin February the 15th. That will offer a path to health care for people who lost their insurance when they lost their jobs. The Republican Party will not automatically back Donald Trump in the 2024 presidential race. The chairwoman of the Republican National Committee, Trump loyalist Ronna McDaniel, tells the Associated Press the party has to stay neutral during a primary battle. McDaniel says what she really wants now is for Trump to help Republicans win back control of Congress in 2022. And British Prime Minister Boris Johnson is trying to quell support for another independence vote in Scotland. Johnson has stressed the backing his government has given Scotland during the coronavirus pandemic. The Prime Minister visits there today. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Forecasts out there say growth is about 4%, but look, you know, if the dispersion around that is significant, you could see significantly higher growth if everything goes very smoothly in terms of global distribution of vaccines, or you could see less than half of that.
Carmen Reinhardt, incredibly important. My essay of the summer by the Reinhardts, plural, the Pandemic, Depression, and Foreign Affairs magazine, and she drives forward the conversation at the World Bank, an important part of our year ahead. Look, right now, well, I want to tell you how the sausage is made here. When Pharaoh leaves, Lisa and I go, okay, let's talk about what we care about. And that's what we're going to do right now on Bloomberg Radio and Bloomberg Television worldwide. Hooni Kim was at Danielle, which is a fancy French restaurant, left that and did what you do, which is redefine cuisine on the island of Manhattan. And that would be in the area of Korean food. It's hugely acclaimed. No other way to put that. And we're thrilled that Hooni Kim could join us now on the challenges at hand. Hooni Kim, what do you need from the mayor, from the government, from Washington, from the governor? What do you need right now?
To be honest, we need all the help we can get. You know, most of the restaurants were far behind in rent, and I think that's the most critical. We just don't have the income or the revenue to meet the rent that we promised our landlords to pay 5, 6, 7, 8 years ago before the pandemic, when our business, the revenue was 90%. Well, basically, we've dropped about 60 to 80% in revenue for most restaurants. and basically it's not enough to pay our staff. It's definitely not enough to pay our utilities and rent. We're just hanging on because the law isn't allowing landlords to kick us out of our restaurants. And when that law disappears, I think most of us are gone. And I really do mean most of us are gone.
So what does the, say, New York City restaurant scene look like post-pandemic, should that happen?
I would think the big restaurants, the chain restaurants, the hedge fund backed restaurants, they're still okay. But that's only 5% of the restaurants in New York City about. Most of the restaurants, most of the restaurateurs that I know, we own our own companies, 1, 2 restaurants, and we're the ones that are in trouble. We're the ones who, our main priority, number one, is to pay our staff, and then it was to pay whatever, and then it was to pay us. And we're all struggling to just even pay our staff week by week. And that's not, that's including not paying rent. So it's not looking good.
There's a question about how much the pandemic has been a transformative moment. It's been absolutely devastating, as you know, and you're talking about for the restaurant industry, but it's also raised some questions about how things will look afterwards, whether it's home delivery kits, whether it's meals to go. What are you seeing and what are you doing now that you think will have a long-lasting footprint on how we think of restaurants going forward?
I think many chefs and restaurateurs were resourceful, so we had to pivot. I myself, I have 2 restaurants. One started to do meal kits and even deliver ourselves. And the other restaurant, we're sort of going the traditional method of just doing outdoor dining and delivering food via the services. I have no idea where this is going to lead, because ultimately the meal service, the meal kit, it's a Band-Aid. It's good enough to meet right now, but that's not going to be the future, because for a restaurant we can't survive based on just meal kits.
I want you to answer, Honi, in the trenches that you're in the struggle you're in, what Lisa and I observe, and I'm sure all our listeners and viewers observe nationwide. Restaurants are closed as a general statement. Do you believe you can run them open now with safety for all involved?
New York City several months ago allowed indoor dining for about 25%. And for me, I asked my staff, would you feel safe? I know they need the money. So I left it up to them. And my staff said no. So we didn't open indoor. And if my staff doesn't feel safe, I don't think most of the diners feel safe.
So what? I don't mean to interrupt. We're going to run out of time, Honi. This is so important. What do you need from President Biden right now to get to February?
I need him to make sure the vaccines are readily available, and week by week it becomes more available, because it feels like the opposite right now. 3 weeks ago, when people were, optimistic about getting the vaccine soon, now, especially in New York, nowhere can we get the vaccine, and it's for anybody and everybody. So we need that vaccine soon now.
Our most important
and at
interview
least the
of the day.
Optimism.
So much with Donji, of course, legendary in Korean cuisine on the island of Manhattan. I'm sorry, Lisa, that's our most important interview of the day.
Yeah, the tone that he had. I mean, it just really highlights the concern and what we're seeing everywhere. I mean, just the shuttered stores, this feeling of the world just on pause. After it's been on pause for a year, people start just getting exasperated.
And Lisa, this goes so much. Who's the guy with a foreign accent? John Farrell. It goes so much to what John Farrell says is we're making excuses here about income replacement, substitution, rent support, landlord support as well, and other nations are doing a lot better job of it, and there's the microcosm right there.
Well, it just highlights, away from the game, the gambling parlor that we've been talking about all morning, there is an economy still very much waiting for these vaccinations, and it's not just when it comes to restaurants, but also with kids, and I know that we both experienced this, Tom. the sort of malaise washing over all of the school kids that are not able to socialize in any real way. It is a very, very real situation with depression and a whole host of other problems, people just being left behind with disengagement. And the question is, how quickly can we unroll some sort of vaccination schedule to release these kids and let them go to school?
Well, there is the moment on the society, and of course that off the claims report, which was challenging again, to say the least. We have a lift in the tape off the gloom of an hour ago. Futures up 19, Dow futures up 206. Yields fractionally higher by 2 basis points. That's not a bad idea. And of course, GameStop, for those of you following, off of 500 now, sitting at 400. An important conversation, the chairman, the chief executive of Dow Chemical, coming up. This is Bloomberg. Good morning.
Focusing on is not so much what goes inside the cars of the future. So they're not working on doing a self-driving car or an autonomous vehicle themselves, but rather they're focusing on the surroundings. So everything that's going to go on outside the vehicle in the future. So that's sensors, cameras, radars that are embedded into roads, street signs, traffic lights, bus stops, infrastructure that's going to provide information, something to help the vehicle know what's going on around it, to help it, stay on schedule if it's a bus, or avoid other vehicles, avoid accidents, provide information about weather conditions, potential hazards down the road, and so forth.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Isn't it, just how sensitive the markets are to any commentary about trade? We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bow. Futures positive 21 on the S&P 500. We're up 0.6%. We begin with the big issue. Retail investors throwing their weight around.
retail investors,
retail traders,
retail trading.
This looks like pockets of frothiness.
You are seeing pockets of frothiness come through.
The pressure point is in the options market.
Retail investors have used a blog to communicate so that they could kill a ridiculous short position.
The GameStop short squeeze.
GameStop, AMC, BlackBerry, and the like.
Stock markets are being democratized.
Markets are performing as markets do.
There will be a lot of regulators around the world scratching their heads.
Regulators, when they act, react to sentiment.
I'm afraid that there could be somebody holding the bag here.
There's always a winner and a loser.
Right now, it's a game of, long versus short.
If you want to avoid these dynamics, just, don't short.
None of this is questionable in my mind. This is the way markets behave.
For more on the story of the moment, let's get to Bloomberg's Sarah Ponczek. Hey, Sarah.
Hey, John. Well, this morning, the mania continues. Now, there were reports just within the last 30 minutes or so that there are some Robinhood clients that are reporting restrictions on the likes of GameStop, AMC, Nokia. And whereas we had seen shares moving higher in the pre-market, this after last night, the subreddit at the center of this all, Wall Street Bets, they went private for a time. They took themselves private. At the time, we saw many of the shares of these stocks fall overnight, but then at the same time, it was just lasted about an hour or so. The subreddit came back online, and earlier this morning, we saw GameStop trading as high as $500 a share. Well, now we see in the pre-market, GameStop now falling after these Robinhood headlines, down 23% at the moment to $269 a share or so. However, there are some of these favorite names that are still in the green and well off in the green this morning. The likes of Koss, the headphone maker, up another 60% after being higher 480% yesterday. Build-A-Bear Workshop up 22% this morning, John, after higher by 42% yesterday. There were a couple names that their tickers all start with double B and they all took off. BlackBerry, Build-A-Bear, Bed Bath & Beyond, for example. Naked Group, we also see fluctuating between gains and loss in the pre-market trade. This after rising 250% yesterday. So the mania is sticking with us. But let's also zero in on GameStop, because GameStop has really just been the poster child of it all, even though it has spread to many other stocks within the market. Look at GameStop so far this month. The past 18 days, up 1,744%. And as I mentioned, this morning at a time, trading over $500 a share. This is a company that was trading under $10 a share not too long ago. So again, it's a mania and it just continues. But let's take a broader look as well. Goldman Sachs has an equally weighted basket of the 50 stocks in the Russell 3000 that have the highest short interest. Even if you take a look this way, we're seeing remarkable gains. Yesterday alone, we saw a gain of 9%. You look at this month, right now, we have seen gains of more than 50%. It's the best month on record for the data, which goes back as far as 2008. And there you can see it on your screen right now, all the way to the right. Well, that's the month of January, John.
Unreal. Unreal. Let's get straight to it. Sarah, thank you. Sarah Ponczek on top of this story through the hour right here on Bloomberg TV. 27 minutes away from the opening bow. Futures up 0.8%. We're plus 30. Jim Bianco of Bianco Research saying the explosion of retail investing has been years in the making. He writes the following: this paradigm shift in investing isn't going away. Even if an overvalued equity market suffers a big correction, the playing field is changing. Jim joins us now for more. Jim, I've been looking forward to this conversation this morning, sir. Great to catch up. How's it changed, and how long will it change?
Oh, I think it's changed. It's changed for a long time. Look, the retail investor has every tool and the availability that every one of your guests, including me, has. They've got free trading. They've got fractional shares. They've got all the information that they need. They've got forums that they can discuss ideas with. There's very little an institutional investor can bring to the table that a retail investor doesn't have, except outperformance. And unfortunately, many of those institutional investors just don't bring that to the table. So the retail investor is taking it upon himself to start investing their own money. And since the spring, they have largely been winning in almost every trade, whether it was buying the airlines after Buffett got out of them, or what we saw with the work from home stocks over the summer, and now going after the short sellers right now. They've got just one win after another, and it's been quite remarkable.
Size. Is size important here, Jim? Does it matter as much as it used to?
It depends on what you mean by size. If you mean that all of these little traders that might have a couple of $100 if hundreds of thousands of them get together at the same time and they buy into the options market, they can have the size bigger than the entire hedge fund industry. And that's what we're finding out right now. If you're talking about do you need size to invest in this, well, with fractional shares, a couple of $100 is all you need to get involved with this. Again, multiply it by hundreds of thousands of people all doing the same thing, and it becomes very significant.
How important do you think the appetite, the proliferation of access to short-dated call options has been in the last few years, Jim?
Oh, I think that the options market has been their way to really play this in a big way, and they've been jumping on it in a big way. And not only that, they've been understanding that the options market has been their way to go about it. Look, let's talk real quick about GameStop. I think it's getting a bad rap. If you go on the Reddit boards, and I've been on there for a while, they understood that there was a mistake being made by the big hedge funds by going over 100% short the outstanding float in GameStop. They saw a vulnerability. I don't know why other hedge funds didn't attack this, but retail banded together and they attacked this, as they should have. The SEC should be investigating the hedge funds for allowing this vulnerability to be in existence in the first place, not the people that took advantage of it. That's capitalism. What's happened to these big hedge funds that are losing money, that's where the investigation needs to be.
So, Jim, you're touching on something a little bit controversial. Do you think the activities that we're really starting to focus on, particularly in the last week or so, will actually force this market to improve price discovery in an almost perverse, counterintuitive way?
Oh, I think it has. I think it has. The biggest way it has is the institutional investor has not been fulfilling the need. After the pandemic and the reopening, the work from home stocks, the disruptive technology stocks have been the place to be. The traditional investment manager who's debating whether or not they should be overweight or underweight financials is not playing in that. The traditional ETF that buys a big broad-based index is not playing in that. The individual investor recognizing work from home disruptive technologies is the place to be. Think Tesla. They said, look, if you're not going to give me what I want, I'm going to do it myself. And they have. And in the case of Tesla, they've also turned out to be a big winner as well. So I think that the institutional community has to realize what is it that their customer, the retail investor, wants. They're not giving it to them. So that customer is moving on and trying to find it on their own. And now that customer is getting sophisticated enough to find vulnerabilities in the institutional community, like with these short sellers, and taking advantage of that too. Why haven't institutional investors been taking advantage of it before retail jumped on it?
So here's the story for me, Jim, and you and I both know we cross paths with a lot of the same people. There are some really smart institutional investors who just blow your mind, and you have to sit back and just listen for hours on end as they talk to you. And then you realize pretty quickly, it's pretty obvious, not all institutional investors are created equal, and likewise with retail. Frustration of mine over the last couple of days, Jim, and I wonder if you share it, it's just the snobbery, just in terms of the conversation that you hear around this big debate that's taking place at the moment.
Oh, yes, it's been sickening to listen to this, that the retail investor is going to lose, that they don't know what they're doing. Even the word sophisticated investor, which is supposed to be a put down on the retail investor as well, too. Look, the sophisticated investor and the institutional investor is the one that's got to ask the questions. How did they miss this? How did they allow this to happen right under their nose? And why did it take a Reddit forum to expose their mistakes? And so, I've really been, upset by the way that everybody's been putting down what's been happening with the retail investor. They're the ones that have had it right so far. Now, yeah, maybe it ends badly in the future, and it very well could. But right now, the lesson to be learned is that there is a problem in the institutional community, and the retail investor is not pleased with it. And that's why we're seeing this democratization, and they're moving on to doing it on their own. And again, they've got free commissions, they've got fractional shares, and the internet is a powerful research tool. And they feel like they've got everything they need in order to move on without the institutional investor.
Hey, Jim, it's a market. We can have an ethical point of view on all of this, but ultimately supply meets demand, and we have to clear a price. And that's financial markets for you. And at some point, someone's going to be holding on to the losses. Jim, I am worried about one thing at the moment, though. It's this kind of two sides issue to this conversation. I'm worried about the people that get stuck in the middle. When you look at some of the benchmarks right now, the Russell, just as an example, the number 2 holding in the Russell now is GameStop. Granted, it only makes up less than 1% of the index anyway. But I do wonder, Jim, whether people who are allocating to this market passively, and they're not part of this active conversation that we've been having over the last 3 days, whether they could be holding the bag also.
Yeah, I mean, there is that I've got worried about too. Not only is GameStop number 1 or number 2 in the Russell, but Plug Power is number 1, a stock that's gone from 7 to 70 over the last 6 months as well. So when people are told to buy small cap stocks, is one instance, because it represents a return to value. Well, the leading the charge have been 2 of the raciest stocks that we have in Plug Power and GameStop in that index as well. And so this idea that you buy these passive indexes under these preconceived notions, that might not be holding right now. So even the passive investor that thinks that they're investing conservatively, thinks that they're avoiding this mess, they might not be avoiding this mess to some degree because it's infecting every aspect of the markets right now.
Jim, do me a favor, reach out to the team. Let's get you back on next week and let's continue this conversation. It's important. Jim Bianco there of Bianco Research. Thank you, sir. About 20 minutes away from the opening bell, equity futures positive 26 points on the S&P 500. A lift. The NASDAQ, a lift, up 53 points on NASDAQ futures too. On these single names, ahead of the opening bell, here's Abigail.
John, well, we really have 2 markets to take a look at relative to these single names. If we start off with the mega cap names, Apple and Tesla, these companies reporting yesterday, we are looking at stocks off of their lows. In the pre-market, Apple had been down more than 2%. They put up a big quarter in terms of sales. A new iPhone super cycle seems to be underway, but the outlook's a little bit tepid, so that's weighing. Tesla missed profit estimates for a stock up 700% last year, perhaps paving the way in some ways for some of these other single stock names that we're seeing soaring today. Price to perfection, not putting it up, that stock down. Amazon and Alphabet, they both report next week. They had been down more than 1% earlier in the pre-market, now trying to bounce back. But the bigger point to make here, John, this board, it is nearly $6 trillion worth of market cap. The next board we're going to take a look at, the state names that have the attention of everybody, about $40 billion. That's the degree of these 2 different markets. American Airlines, of course, reporting, but the bigger point here, 26% short interest. So this is one of the new message board stocks. Costcorp, $2 stock at the beginning of this year, now $96, up once again on this short squeeze, this option play. GameStop reversing on the idea that perhaps this one has seen its day, $500 earlier in the pre-market, now $300. So much money being made and lost. It really is pretty amazing. But again, $6 trillion worth $40 billion. What's the real market, John?
The attention is on the latter and not the former at the moment, Abigail. We'll continue that conversation. Coming up, the retail revolt, reaching the doorsteps of the White House. And guess who? Federal Reserve, Chairman Powell. That conversation up next with JP Morgan's David Kelly. Looking forward to that. That's next. This is Bloomberg.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Our team is, of course, our economic team, including Secretary Yellen and others, are monitoring the situation. It's a good reminder, though, that the stock market isn't the only measure of the health of our economy. It doesn't reflect how working and middle-class families are doing.
The GameStop saga reaching Washington, D.C., grabbing the attention of White House Press Secretary Jen Psaki. Among others in Congress, Senator Elizabeth Warren demanding regulators take action. She tweeted the following: "It's long past time for the SEC and other financial regulators to wake up and do their jobs. And with the new administration and Democrats running Congress, I intend to make sure they do." Bloomberg's Danny Berger joins us now for more. Hey, Danny.
Hey, John, one of the important things about that Elizabeth Warren tweet was she kicked it off by saying that describing hedge funds and private equity funds and other large managers who've been using markets as their own personal casino. So the sort of language we've started to hear, at least when it comes to specifics, is not necessarily saying, hey, we're going to start to regulate what's happening on Reddit and what's happening with these retail investors. What we've heard from the SEC, from the Biden administration, it's been vague enough just to say, hey, we're not asleep at the wheel. We are paying attention, but of course, it's really difficult to show any types of fraud or market manipulation. Now, what we're more likely to see, and indeed what we are starting to see this morning, is perhaps self-regulation from some of these platforms. Interactive Brokers just 10 minutes ago said that they're going to limit the trading. They're only allowing liquidation in stocks like GameStop, AMC, these Reddit favorites. Robinhood users are also reporting issues buying these shares. We've seen Schwab say that you can't buy on margin anymore. TD Ameritrade is also placing limits as well. And that's part of the reason why we're seeing GameStop stock turn around today. So look, these hedge funds, the overall market, there's been an impact. Surely the SEC has had a lot of voices in their ear saying you need to take action. So far, John, the concrete action we are seeing is coming from those retail trading platforms themselves.
Danny Berger out of London. Danny, thank you. Let's get to JP Morgan's David Kelly. He says the GameStop revolt should serve as a warning to the Federal Reserve. Quote, "The Fed's excessively easy monetary policy can fuel bubbles that end in recession." Pleased to say that David joins us now. David, just briefly, let's take a listen to this. This was Chairman Powell asked about this issue on rates and asset prices. This is what he had to say.
If you look at what's really been driving asset prices really in the last couple of months, it isn't monetary policy. It's been expectations about vaccines. And it's also fiscal policy. Those are the news items that have been driving asset purchases. The connection between low interest rates and asset values is probably something that's not as tight as people think, because a lot of different factors are driving asset prices at any given time.
That final piece right there. David Kelly, your response, please.
Well, while I respect the job that Chairman Powell is doing in general, I don't really agree with that. I think, it's too much to ask for there to be an exact correlation month to month between very easy liquidity and the rise in markets. But there's no doubt that a long period of time with negative real interest rates is feeding speculation, as it has done over the ages. I mean, the SEC or whatever regulators can do whatever they want, but it's basically whack-a-mole trying to prevent bubbles of excess, because that's going to occur when capital is this cheap and basically, out of equilibrium. So what I think Chairman Powell is trying to do is he wants to keep rates low to facilitate an economic recovery. So he doesn't want to give any hints that they would be sidetracked into tightening because of this kind of behavior. But what it does say to me is that we need to get fiscal stimulus in place. We need to get the economy recovered. We need to get the pandemic over.
Yeah.
And we need to get monetary policy back to normal, because while we have this very easy monetary policy, this kind of thing is going to happen over and over and over again.
We heard this in the last cycle, didn't we, David? People would push back and they say, we've got macro-prudential tools. Heard that in the UK with the property market in and around 2013 with Governor Carney. Hearing it again now. Do you see these financial stability risks brewing to the extent that you think they could be a threat to the cycle?
Yes, I do. And I mean, I think it's a bigger long-term threat, which is the value of total financial assets is growing completely out of proportion to the output of goods and services in the economy. This has been going on for 30 years and it's getting worse. And the problem is that every one of these financial assets in the end is a coupon that allows you to buy some of the goods and services produced by the economy. All these people holding stocks and mutual funds and assets and options, they all think that at some stage they can go out and buy goods and services with this, but there aren't enough goods and services to do this. And therefore, eventually, these asset prices will fall. And the Fed's job is to take away the punch bowl so the party doesn't get out of hand. But they do need somebody, they need fiscal policy to try to get the economy back on an even keel so they can do that.
Well, let's talk about policy, David. You've made the point yourself that the reaction of society, not the event itself, is what shapes the path forward. You add in to how much we have shifted the conversation around policy. We really have redefined things like fiscal hawks down in Washington, D.C. That definition that applied 10 years ago does not apply now. David, walk me through your thinking at the moment and your latest thinking.
Well, I think that what we have is sort of the foot to the accelerator, both in fiscal and monetary policy. We'll have to see what happens with the Biden rescue plan. But I think we will see most of that implemented, and that gives us a huge head of steam as we head towards the end of the year. Now, the real question, I think, for Washington isn't, should you stimulate the economy, should you support the economy now? But do you have the intestinal fortitude to actually apply the brakes, both to monetary policy and fiscal policy, when this economy is recovered and when the pandemic is over? Because that's what I worry about. I worry that having turned on all the stimulus, we won't be able to turn it off until it all blows up in our faces. So in the meantime, what do you do, David? What's the core position for you? What are the conviction trades? Well, I think the key thing is look at valuations. That is obviously not what's going on with some of these stocks. But in the end, when there's a flood of liquidity, the things that are silliest can rise the highest. But when that tide turns the other way, you'll want to know that what you own has value. So when I look at it, value stocks in the US are relatively cheap. International stocks, both European stocks and emerging market stocks, are relatively cheap. Mega cap stocks are expensive relative to the rest of the S&P 500. There are areas of value out there. I think also physical assets in a world where there's so much liquidity is probably a good idea. So there are opportunities there, but I think this is a year for valuation. Last year was about momentum. I think eventually this year is going to be about valuation. At some point, I think we've all been hoping for that to happen. David, always great to catch up. What a bizarre couple of days it's been. David Kelly of JP Morgan Asset Management. Thank you, sir. Coming up, the analyst action you need to know. That'll be next in our morning calls, and later, the darlings of big tech disappointing on earnings. That conversation still ahead with Chris Caso of Raymond James. Would you believe it? Abigail mentioned this earlier. Trillions of dollars worth of companies delivered earnings in the last 48 hours. Hardly even part of the conversation. We'll make it part of the conversation in just a moment. From New York with futures higher, this is Bloomberg.
That was either illegal or caused disruption. And this was really political satire, kind of writ large, and it was all about actually trying to get to the man himself and make him see how we see him. And in order to do that, we knew it had to be big and it had to be colourful and it had to be somewhere where everybody could see it. It's important because we didn't just do this for attention. This was actually about making a serious point, which is that the majority of people in this country do reject the politics that Donald Trump represents.
minutes away from the opening bell. Your equity futures pushing higher going into the open. We're positive on the S&P 500. We'll get to the big stories in a moment, on the big names, on the big earnings, a little bit later. Let's get to some analyst action this morning. First up, KeyBank upgrading Twitter to overweight with a $65 price target. The analysts seeing meaningful improvements to the company's platform for users and advertisers. We're down about 3% there. Your second call from Deutsche Bank, downgrading eBay to a hold, $59 price target. The analysts saying the company failed to capitalize on structural tailwinds towards online retailers during the pandemic. We're down about 1.4% on that stock. Your third and final call comes from the team over at Morgan Stanley, raising its Apple price target up to $164. The analyst expecting fresh products and working from home trends to fuel double-digit revenue growth in the coming quarters. The capital return program since 2013. I want to go through some of the numbers a little bit later. We'll do that next and get to the earnings too with Raymond James's Chris Casso. That conversation is coming up next as we count you down to the opening bell. Let's take a little look at futures on the S&P 500. On the NASDAQ, we shape up as follows. We're positive 0.4% on the NASDAQ. We're up 0.6 on the S&P. From New York this morning, good morning. Your opening bell this Thursday morning is next. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's a word that stuck with me 12 months ago, and I think we all need to respect it. Humility. Be humble about the moment we're in. One side of the story doesn't have all the answers. Getting all philosophical with you going into the open. Getting told off by my producer. Futures up 0.9% on the Russell, up 0.4 on the Nasdaq. Up 0.6% on the S&P 500. Switch up the board into the bond market we go. We're set up as follows on Treasuries. Yields up 2 basis points to 1.0364%. In the FX market, Euro showing just a little bit of strength. Euro dollar up to 121.28. Crude up 1%. As Tom would say, no one cares. Let's get to the market desk and get your movers. Here's Abigail.
Well, John, let's start out with the sensationalistic speculation stocks because they are mixed at this point, although the mania for the most part does continue. Now, of course, joining the party today, American Airlines, because most of these companies' stocks were thought to be dead. Bricks and mortar company or other technologies that weren't really that popular. But American Airlines, of course, very much a real company. They put up a strong quarter as they adapt to the pandemic, hoping that that will move forward as the vaccine gets out there. But the bigger point here, the reason the stock is up 21%, that 26% short interest. But it doesn't work out so well for everybody because take a look at GameStop. Now that we have some of these brokers saying that they're not going to be able to trade some of these names or their limit options, GameStop pulling back from its highs, now $292, earlier $500. You were talking about people squeezed in the middle. Those day traders, not all of these day traders are trying to squeeze out the short. Some of them are just trying to make a buck. Some of them are losing big bucks here. Costcorp, the $2 stock earlier this year, headphone company, up 42%. Tootsie Roll, who knew we'd be talking about Tootsie Roll? It had been up sharply higher. So again, these are those sensationalistic speculation companies, the mania, the bubble, $43 billion worth of market cap there, John. Let's turn to a board that has more than $6 trillion worth of market cap, not receiving quite the attention that perhaps it should, but there's Apple down 2%. They put up a very strong blowout quarter. The outlook a little bit tepid. Tesla down 5%, price to perfection. They didn't put up perfection. Microsoft put up a good quarter earlier this week. Now that stock is recovering off of its pre-market lows. Amazon next week. But again, the bigger point here is these are the stocks that should really be moving the markets and really gaining investors' attention, but instead it's those small cap, little cap companies that are just moving wildly on the day, John.
The frenzy, the mania on the one side, big tech earnings on the other. Let's get to Bloomberg's Ed Ludlow for more. Out of San Francisco on the West Coast. Hey, Ed.
Yeah, really investors weighing decent financials from Facebook and Apple against cautious outlooks for the rest of the year, right? Facebook reported a 33% surge in fourth quarter sales, driven by demand for digital ads on their platforms, which in turn is being driven by demand for consumers doing online shopping. This continues to be a pandemic story. Facebook also saw user growth in the quarter because, simply put, more of us are still at home and connecting with each other online. But when it comes to the rest of the year, they did flag uncertainty and caution because they don't know what's going to happen with the vaccine rollout, John. And with 2020 in the rearview mirror, you know, it would seem with hindsight that Facebook was a beneficiary from this pandemic. Similar story with Tesla. You know, it's the first time that Tesla has missed Wall Street estimates since July 2019. They did well on revenue, $10 billion, which is a record, but margins are under pressure. They've had to cut prices aggressively in China. They had big compensation payouts for executives. And you can see there on your screen that once again, regulatory credits continue to play a role, raising the question long term of how Tesla can be sustainably profitable if you strip out regulatory credits. They also did not give a full year 2021 forecast for how many vehicles they said they would deliver, but they said that it would be an annual growth rate of around 50%. So investors weighing that, but perhaps disappointed. Expectations very high. Finally, John, I want to talk to you about Apple because I know you've been waiting for this for a very long time. The iPhone 12 5G related upgrade supercycle. There are signs that it's here, you know, blowout revenue for Apple, above $100 billion in a quarter for the first time. What was interesting was the China demand for the higher price versions of the iPhone 12 handset, and Apple talking about pent-up demand for 5G. Of course, 5G capabilities in China are much more advanced. But again, this cautious outlook for 2021, particularly with Apple saying that we should expect sales, services sales, as well as wearable sales to potentially slow throughout the second half of 2021. John?
Just a bit of transparency, you know. It's exactly what I did. I hadn't upgraded since 2018, and it was the first thing I did when I got back to New York was upgrade the phone. Ed, just quickly, this is the first time I've had a conversation about earnings for longer than about 3 minutes this morning. What do you make of what's going on, Ed?
I think expectations are really high for big tech, right? You know, we've been talking about how there's this outsized profit expectations with the mega caps. I'm talking Facebook, Microsoft, Apple, Amazon. A big part of it is the pandemic story, particularly if you go back to Microsoft and what they're doing on enterprise cloud. You know, we also saw Amazon shares gain in the aftermath of those Microsoft results. Amazon's to come later next week. A lot of those big themes that we were talking about with the pandemic have not gone away when it comes to big cap tech stocks. You know, particularly in the case of Apple and Tesla, although there's some debate about whether we treat them as a tech company, of course, expectations were very high. You have to remember that in the second half of 2020, a lot of these tech stocks trailed the S&P 500 and the SOX, the Philadelphia Semiconductor Index in particular. But what happened towards the end of the year is those expectations started to become elevated and those tech stocks started to show some signs of outperformance. The question now going forward throughout 2021 is, well, hold on, was this blowout year in the backdrop of a crazy economic recession tied to the COVID-19 pandemic? Do all those things suddenly go away when the vaccine is rolled out? Do all of these COVID impacts and positives that these big tech companies are feeling, if they're consumer facing or they have digital ad platforms, what happens when we're all going back to work and back in the office, John? And investors are kind of weighing that equation right now.
Ed, great to catch up, sir. Thank you. 5-6 minutes into the session, we look like this on the S&P 500, up 0.8%. Pulling back on real estate, down 0.4%. Communication services, up about 2 percentage points and change. Sticking with the earnings from big tech, Chris Casso of Raymond James raising his Apple price target to 160 with an outperform rating, seeing a lot to like in the company's quarterly results, writing, quote, "The company delivered on all fronts." Chris joins us now for more. Chris, great to catch up. Walk me through what impressed you.
Well, good morning. Well, you know, really this is what we have been waiting for some time with regard to the 5G cycle. The December revenue was a quarterly record. Was much better than what the street had expected, and that was particularly interesting in light of the pandemic, where you had a number of stores that were closed, as well as the fact that the phones came out later in the season than normal, and therefore there was less time to sell them. So really quite an extraordinary result in light of all the conditions that were underway.
Widely expected though, Chris, and the stock kind of sideways since early September. What do you make of that, Chris?
Well, listen, we've been, you know, in favor of the stock for about 18 months now. So, you know, a lot of folks knew about this cycle. The expectations were already high and you know, get dialed in pretty quickly. And certainly even 3 months ago, certainly not today, you're not buying Apple for, you know, this current iPhone 12 cycle. You're buying it for what's happening next year. And that's really the question right now. And our view is that the 5G cycle is not a one-year cycle, it's a 2-year cycle. There's a number of geographies around the world that don't have 5G coverage yet. Yeah. We're expecting a new form factor next year, you know, new features on the phone. And the other factor that's important is that Apple doesn't report units anymore, but we believe, and they certainly alluded to this in the call last night, that mix had a lot to do with with the upside right now. And so consumers are willing to pay more for the higher end Pro and Max versions of the phone. And we believe that that's permanent, and that stays in numbers going forward. In addition, because you know we don't think the units blew out to the upside, that means that demand wasn't pulled forward from next year. And the bottom line is we think this 5G cycle is at least a 2-year cycle in terms of people upgrading from 4G.
Chris, just to finish on this final point, I think many people familiar with this program and who know me know that I'm very respectful of the homework that goes into things on the south side. I just wonder for you at the moment, in this very moment, Chris, how difficult it is to come up with a multiple to put on a name like Apple, given the mania, the craziness happening all around us.
Yeah, and you know, I agree. It is difficult. I think you know what's happened. Apple's multiple has re-rated over the last year, anyhow, before all the recent craziness had started. I think that what people are looking at Apple is that it's you know not just a hardware company, that you know certainly has some services element which have been very strong as you're monetizing the installed base, and there's new products to come. In any time when you're in uncharted territory, and Apple certainly is in uncharted territory regarding where the multiple is now, it's hard to peg down and say this is absolutely the correct multiple. Our approach is that if we think that numbers are still going up and the trends are in the right direction, we're still willing to own it.
Chris, keep it simple. With this name, it's been that simple. Chris, great to catch up, sir. Chris Casso there. On the latest with Apple, looking at the S&P 500 up 0.75%. Need to get back to the market desk. Back to Abigail. Hi, Abby.
Hi there, John. Well, let's go somewhere we have not been able to go yet this week, and actually for you and I this year, and that is the reflation trade. We're taking a look at the banks and oil because we have a bit of a recovery here. And the reason this stands out, over the last 5 days, we've had the reflation trade really sell off. But today we have the banks higher as yields back up. We have the big oil names trading higher as well with oil up. So this is a sign of health for the markets, maybe some stabilization. It has been smokescreened, however, by all of these retail names, the bubble names, which are now trading wildly both up and down. Behind that smokescreen of these big names trading, we have had, again, this reflation trade working out. But in the meantime, today, American Airlines all over the map. Costcorp is now still higher. GameStop trading slightly higher. AMC, but this wildness, it's been hard to focus on the bigger parts of the market. And of course, another piece of the bigger parts of the market that we've been looking at this morning, Apple and Tesla, both of these names not delivering the perfection that some want. But again, that might help out the reflation trade because folks aren't going to the defense of big tech, John.
Abigail, thank you. I did promise on the program a little bit earlier I'd go through some of the capital return numbers for Apple. This is from Walter Piecyk over at Lightshed in the last 24 hours. Since 2013, $400 billion. The share count's been cut by 35%. Unreal. The financial engineering that has supported this name over the last 7 years. Coming up, Fed Chair Jay Powell avoiding the GameStop saga, staying focused on the economy and the US recovery. That conversation up next with Invesco's Rob Wagner. And just why does Michael McKee not get the first question anymore? I think we all know why. That's up next on Bloomberg.
Continues to be, recovering well. And with the opening up that was decided at the last 5-year plan, that is a golden opportunity for many international banks.
So we'll look to double our footprint across IB and also wealth management and asset management in the 3 to 5 year time frame.
Growth outlook structurally is very strong. But it does need to consolidate and allow time to help the share price appreciation to move more in sync with the growth.
So China can avoid further decoupling if they stop these inappropriate actions.
But at the moment, we really want to see the dust settle first on international relationships, on China's role in the global economy.
I don't see a likelihood of a big change in the policy with the change of administrations.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I was hoping that you would first react to the wild ride that GameStop stock has had this week.
I don't want to comment on a particular company or day's market activity or things like that. It's just not really something that I would typically comment on.
Who was that before Chairman Powell? Who was that? I recognized her. Gina Smilik of the New York Times, formerly of Bloomberg. Chairman Powell does not want to comment on what's happening in this market. Abigail Doolittle does. Hey, Abby.
Hi there, John. Well, interesting because what goes up must come down, and we're seeing some of that craziness with some of these retail mania names today. So much so that we have a halt on trading on a few of them, including GameStop, of course, AMC, and Express. We also have a redhead here, Robinhood restricting transactions for GameStop, AMC, BlackBerry, and others. So if the SEC and regulatory boards aren't taking a position, we have some of these broker-dealers doing it. It's going to be interesting to see how all of this plays out. Good time to fasten the seatbelt. Wild ride ahead, most likely, John.
A frenzy, it continues. Michael McKee dropping by to catch up with us. Mike, you're in the news conference. It wasn't really about inflation. I'm sure the chairman wanted to make it about the labor market. It was about something else.
Everybody wanted to know, what's the Fed going to do about GameStop? And, of course, the Fed can't do a whole lot about it. But there are a lot of reasons why the Fed has been indicted in the general sense for this. I mean, you take a look at what they're doing. They're caught between a rock and a hard place. The economy is not in good shape, so they are stimulating as much as possible, including buying $80 billion a month of U.S. Treasuries. Well, when you look at the Treasury buys from the Federal Reserve and you look at the S&P 500, it's almost a complete correlation. It doesn't necessarily mean causation, but that's the way people on Wall Street see it. So one of their first questions is, Jay, what are you going to do about it? And he made it clear he's not going to do a whole lot. Now, the Fed does have a tool they could use, and that is margin requirements. The Fed has been looking at the margin requirements for the S&P 500, well, for all securities, really. They haven't changed it since 1974, 50%. So they could raise that to try to cool a little speculation. Jay Powell said they weren't looking at that. They don't think they need it right now. But the interesting thing is, in these brokerages, these online brokerages this morning, we're seeing them raise margin requirements. Interactive Brokers, 300% now on option trades. So that's an option for the Fed, but if the brokers are going to do it themselves, they might as well. The economy in bad shape. Just want to point out to you that there is more evidence of that today with the GDP report comes in at 4%. Ordinarily, you'd cheer that, but when you look at consumer spending for the fourth quarter, just 2.5%. And that is behind the Fed's statement yesterday that the economy seems to have moderated in the fourth quarter. When you look at what was going on, we see people losing jobs, closing down, and people just not spending money. And that's money that may not come back. So the Fed feels it needs to keep stimulating, which, of course, keeps this whole carousel going.
The green light is still on. Mike McKee, thank you, sir. Invesco's Rob Wobner joining us now. Rob, I'll keep it short to start. What's going on?
Hey, Jonathan, thank you very much for having me this morning. Well, what's going on is I think the Fed has got it right, which is they need to keep stimulus in the economy to support growth. And what we actually have is growth being held back right now. So we're not seeing it come through in growth like we might like because it's being held back by fears around this virus. But we think we're at a kind of a peak of pessimism around the vaccine and the virus and herd immunity. If you look at the virus numbers, they're peaking out. Hospitalizations are peaking out. We think there's good news to come for the markets in terms of that virus news relative to current expectations. And that should boost both the economy and the markets going forward.
Well, let's talk about the markets and fundamentals and whether those fundamentals matter, the extent to which they do. Rob, in the bond market, we can agree that various parts, large parts of the global fixed income market have been zombified by central banks, a price-insensitive buyer loading up and putting those assets on the balance sheet of, say, the ECB, the Federal Reserve, the BOJ, and elsewhere as well. Rob, that's fixed income. In the equity market, increasingly, we've seen evidence over the last 12 months that single names and a whole index can just become the plaything of the options market. Short-dated call options, driving the underlying, and we've seen the tail wag the dog multiple times. Do fundamentals matter less this time around, Rob? Is something else going on? Do you and I need to change the way we talk to each other on a show like this?
No, fundamentals matter, Jonathan, but there are, because there's so much stimulus in the system, and I know we're looking at Powell, we're looking at the monetary policy that's in this system, but don't forget on fiscal policy, we've been giving checks to individuals. Savings rate has risen tremendously during this recession, which I think gives people more near-term savings that they can use to put in the market to do these kinds of activities, as you point out, on a levered basis. So the fundamentals do matter, but we are going to get these pockets of speculation, and many of these assets, these are just speculative moves, or driven by technicals on market structure. Because let's face it, when with the short outstanding that you had in GameStop, with hindsight, it seemed like that was a very that was something that was there for the herd to take advantage of, and they did.
Where are you comfortable taking risks right now, Rob?
So John, we think that you got to keep your mind on the fact that we're coming to the end of this pandemic.